Are you ready to take control of your financial future and build lasting wealth through strategic investments? Investing Made Simple is your gateway to the world of investments, offering expert insights and practical strategies to help you minimize risk, maximize returns, and grow your wealth. Hello, this is Samuel Farron, and you're listening to Investing Made Simple, strategies for building a profitable investment portfolio through real estate, stocks, options trading, index funds, bonds, REITs, Bitcoin, and beyond. Provided to you by United Audiobooks. I hope you enjoy my audiobook. Now, let us begin. Introduction. Although we have a sneaky notion you know what investing is, let's define some terms first. After that, we'll explain how to proceed. What is investing? Investing entails making a financial commitment in the hopes of generating a profit. This means you invest money to generate income and meet your financial objectives. Many people invest their money in the stock market to achieve their long-term financial goals since they can expect a high return. But for new investors in particular, investing can appear frightening and intimidating. Fortunately, many choices are regarded as the best investments for beginners and fit various goals, spending limits, and comfort levels. If you're just starting, investing may seem overwhelming, but it's essential in growing wealth and saving for various financial goals. Don't become too preoccupied with whether or not now is the best time to begin investing, because you will encounter various market settings during your career. However, before making any investments, new investors must be aware of their risk tolerance. Some investments are riskier than others, so you don't want to get a rude surprise after you've made a purchase. Consider your ability to go without the money you will be investing and whether you can go a few years or longer without having access to them. No matter where you put your money into investments, you essentially donate it to a business, the government, or another organization hoping they will give you more money. The majority of the time, when people invest money, they have a particular goal in mind, such as retirement, their children's education, a house, and the list goes on. Trading and saving are not the same as investing. Investing is typically connected with setting money aside for a long time instead of trading stocks regularly. Saving money is safer than investing. Investments are not always assured, but savings are occasionally assured. You would never have more money than you had saved for yourself if you kept your money hidden under your mattress and didn't invest it. Consequently, a lot of people decide to invest their money. You can make various investments, and this book will cover them all. Given that you are reading this book, we can assume that you are keen to grasp the basics of investing. The most popular options will be covered in this book, but a financial advisor can also help you choose the best course of action and offer guidance when you make your first investments. Chapter 1. Introduction to Investing. To put it simply, investing can help you succeed in life. It may be essential to your ability to develop your worth over time and secure the kind of future you want for your family and yourself. It might even enable you to make money while you sleep. There is no doubt that learning how anything works is worthwhile. But it's a lot when you're new. Lots of options, unfamiliar terminology and ideas, and challenging, often conflicting counsel to sort through. Additionally, it might be stressful because it involves putting your money on the line. However, it doesn't necessarily have to be complicated simply because it can be. To begin investing, you only need to make a few key decisions. Let's dissect everything. But first, the basics. Why should you invest? There are several reasons why investing your money is crucial. You want to make money for future ambitions, help in times of need, job loss, or both. It would help to use compounding while accounting for inflation to prevent your money from losing value over time. Additionally, investment is important to help reach your goals if you intend to retire and stop working at some point. Let's look at some factors that make investing so crucial. Wealth creation. Wealth may imply different things to various people. It could be a specific sum of money in your bank account or a set of financial objectives you have established for yourself. In either case, investing can help in your progress. If you aim to pay off debt, put your child through college, purchase a home, launch a business, or save for retirement, investment can help you get there more quickly than just letting money sit in your bank account. Investing can improve your wealth or the worth of all of your assets. Creating wealth is a long-term goal that will benefit you. You can leave a financial legacy by creating generational wealth through investment. In addition to giving your children a solid financial foundation, passing wealth down to future generations could help close the wealth gap many communities are struggling with. Compounding. Compound interest can be used to your advantage while investing. Compound interest is the interest you receive on the money you invest plus the interest from each previous period. Sometimes, it is referred to as interest on interest. Compound interest enables speedy wealth growth. For instance, your total investment would be $9,000 if you made $50 a month for 15 years. In that period, assuming a 10% rate of return, compound interest would allow the $9,000 to rise to over $19,000. Reduce inflation. The general increased tendency in product prices over time is referred to as inflation. Your money will purchase less today than it did yesterday if prices rise over time. Even though the cost of living has grown, your money will be much less valuable if there is inflation over a 30 or 40-year period. One way to fight inflation is to invest your money. If you earn more than the rate of inflation, your money will be worth more tomorrow than it is today. Retirement. You must have a sizable sum of money set aside to support yourself when you stop working if you plan to retire and stop working. The difference between your savings and what you'll need to live on for the next 20 or 30 years can be filled by investing. Working backward from the retirement savings target you've set for yourself, you can begin investing for retirement. Thinking about your desired retirement date, anticipated retirement lifestyle, and costs will help you reach that figure. You can then develop an investment plan for retirement that balances your present financial condition with your desired retirement lifestyle. Common investing misconceptions and myths. Because they appear genuine or near the truth, some of the most pervasive myths are challenging to separate from reality. Confused? Here's an illustration. A mother asked her son if he had finished his schoolwork. "I've finished exercise too," he said in response. Even though his statement might be true, it doesn't solve the homework completion problem. Even if the son had told his mother the truth, he might still have misled her because this exercise too was only a small portion of his schoolwork. The same is true of convincing investment myths. It is easy to become a victim of financial misconceptions because of many moving components and unforeseen possibilities. Investors are often misled by these myths, misunderstandings, and near lies, which cause them to make foolish financial decisions. Therefore, understanding the differences between investment myths and reality is the key to becoming a good investor. We'll outline this section's top 7 investing myths so you don't fall for them. Myth 1. It is too risky. There are risks associated with investing, yes. Because of this, it is always accompanied by the disclaimer, you may not get back what you invest. Yet too perilous? Before you can respond, we must first investigate how risk operates and what it might entail. A scale of risk can be used to classify all investments. High-risk, volatile investments like hedge betting are at the scale's end. These are not for the timid, as your initial investment's value may fluctuate greatly. This implies that you might profit greatly or possibly lose everything. This kind of investment is not one we recommend. Some extremely low-risk investments labeled as cautious can be found at the sad end of the spectrum. Invest in one of these, and even if there is risk involved, it is unlikely that the value will change much. As a result, you might eventually experience a milder, smoother ride. There is an investment for every risk appetite, from the conservative to the daring and everything in between. Understanding the risks involved and how they could vary over time is crucial. In this manner, you can decide how much risk is appropriate. Why even take a risk? In short, it could provide your money with more growth potential than cash savings. Myth 2. You have to be rich. Despite the fact that it used to be the case, you can now begin investing with less money than you might anticipate. And it's now easier than ever thanks to smartphone applications, online fund platforms, and online investing advice services. You can start investing online or using our mobile banking app with a one-time contribution of £50 if you have an eligible or active savings account. There are further prerequisites for eligibility. There is a 0.25% quarterly yearly account charge, as well as ongoing fees equal to 0.25% of the value of your investments. Before you apply, you will have access to the breakdown of these expenses. Myth 3. You must lock up your cash. It's likely that you've encountered phrases like, you should aim to hold it for at least 5 years, or An investment should be seen as a medium to long-term commitment. This is due to the fact that the likelihood that snags will be smoothed out increases the longer you hold on to an investment. This does not imply that you must physically lock away your money. Most investments don't lock up your money or charge fees when you sell your investments. You always have access to your money. An investment shouldn't be viewed the same way as a savings account. Early withdrawals could have a detrimental impact on your results. Avoid being compelled to sell during a market collapse since your investments can be worth less than you invested. Before investing, you should set aside 3 to 6 months' expenses in an emergency fund. Therefore, you can utilize your money to fix your automobile if it breaks down while the markets are in uproar. In this manner, you can let your assets grow while giving the markets time to stabilize. Myth 4. You must be a professional. You must research and monitor the markets if you decide to invest in shares. This is due to the possibility of a financial loss if the firm in which you invest performs poorly. The overall state of the economy, interest rates, and supply and demand will all impact the price of your shares. But purchasing shares isn't the only investment option. Funds may be a smart place to start if you're new to investing. Purchasing a fund is similar to purchasing a ready-made investment basket. They disperse your funds over numerous investments, equivalent to putting all your eggs in a basket. Investing in funds rather than individual shares of a single company can reduce risk. This is so that a higher return on another could offset a lower return on one investment. This method of risk distribution is referred to as diversification. The fact that funds are put together by a fund manager, an expert financial professional, is arguably the best part about investing in them. Essentially, you are paying a professional to make investments on your behalf. The charges paid to the fund manager are taken directly out of the investment. Myth 5. You should keep an eye on your investments every day. Keeping a close eye on the markets? Most likely, you have better things to do with your time. This is yet another factor that makes pre-built portfolios a viable investment option. They are expertly managed to ensure they remain at the level of risk you specify. You can make an investment with a pre-made portfolio and then essentially set it and forget it. To check on its progress, you only have to sneak a peek now and then. Even if you invest in shares and adopt a hands-on strategy, you don't necessarily need to track them daily. The majority of online share trading providers provide features to help with this. By setting up share price notifications, your phone will ring whenever a stock rises above or below a specified level. Myth 6. You must understand when to make a purchase. There is a belief that to profit from the markets, one must buy stocks when they are cheap and sell them at a profit. Investors might need much time and effort to determine when a share price has peaked or bottomed out. But there are a lot of things that affect the stock market. Results are essentially impossible to predict. Both crucial are starting as soon as possible and continuing your investments for as long as possible. There will be some downturns and possibly some difficult years, but if you're not compelled to sell during a downturn, see Myth 3, you might be able to weather any storm. Consider your investment horizon before making a decision. More volatility can be manageable if your time frame is longer because you will have more time to bounce back from any lows. For instance, you would want to make a conservative investment if you have 5 years till retirement. You might be able to be more daring if you had at least 10 years to play with. Once more, if you're unsure what's best for you, you can ask a financial expert for their advice. Fees and eligibility requirements apply. Myth 7. It's an easy way to get rich. Influencers on social media may claim it's easy to profit from risky trades, but don't fall for it. Consider what transpired during the dot-com bubble in the late 1990s and what has happened with cryptocurrencies over the past several years. In general, markets favor long-term investors. It would help to have discipline, patience, and a cool, calm head instead of passion to allow your investments to flourish. Chapter 2. Building a strong financial foundation. You're not alone if setting financial priorities seems like an intimidating task. Quite a few people put off managing their money because they don't know where to begin. Should I get life insurance or maximize my retirement savings? Which should I prioritize? Saving for a home or my child's college fund? Financial tasks can be divided into smaller, more manageable segments to help with planning. As you create a financial roadmap for you and your family, consider the following. Set financial goals you can keep. The financial goal involves any strategy you have for managing your money. You can set short-term and long-term financial goals, such as saving $1,000 or investing for retirement. Every area of your life should have goals, but clear financial objectives enable you to put your money where your mouth is. Additionally, I cannot discuss financial goals without mentioning the baby steps. Making financial decisions can be as challenging as deciding what to watch on Netflix. There are so many choices, and everyone has a preference. Do you need to pay off debt? Do you put money aside for your children's college? Buying a home? Investing for the future? Your road to completing all these tasks is apparent in the 7 baby steps, which cut through the chaos. It helps you concentrate on one goal at a time to achieve more progress with your money and enjoy the financial calm. So, if you don't know how to set financial goals, keep the following in mind. 1. Try to avoid setting too ambitious goals. It may be easy to feel as though you must achieve all of your financial objectives at once, such as maxing out your retirement contributions, fully repaying your debts, and cutting back on your discretionary spending to boost your savings. However, if you set goals that are probably beyond your current reach, you can feel let down if you don't reach them. The all or nothing mentality is one of the difficulties in setting goals. It's an extreme viewpoint, and when we act in that way, we leave ourselves open to failure because we don't take into account all the gray areas in life. It won't be easy to check your budget and ensure you have an extra $500 each month if you aim to save $500 but haven't even begun saving $50 a month. Even if your goals seem small, like saving $50 per month, doing so will help you develop sound money management skills you can maintain over the long run. You can feel driven to move on to bigger goals by accomplishing your present goals. 2. Concentrate on bringing forth progressive changes. Focusing on goals that allow you room to develop over time will help you avoid setting too aggressive ones. One tactic is to commit to doing something like, I'm going to increase my savings by 1%, and every few months, I'll review my budget and increase my savings by another 1%. More unsustainable than doing the opposite is going from saving nothing to saving a significant sum of money. Additionally, it's important to remember that things might change. You could spend more money in some months than others because of notable occasions like holidays, birthdays, and weddings. Your spending might be a little less in some months. Because of this, it's crucial to extend yourself some mercy and begin by making small, beneficial changes to how you spend your money. Additionally, when your income and budget rise over time, you might have additional room to advance even further toward your long-term goals. 3. Recognize that unexpected financial occurrences will always happen. It might seem great to progress toward any financial objective, such as paying off credit card debt until you need to use your credit card again in an emergency, and the payoff cycle begins again. Even when you've accomplished a major goal, managing your money still involves a lot of emotion since you could feel additional pressure to keep it up. When it seems like there are always fresh expenses slipping up on you, that might be challenging to achieve. With money, there's always this unforeseen circumstance that arises. It becomes easier the sooner we accept that as a fact. Perhaps your car breaks down, or you receive a surprise bill. It would help if you incorporated this into your financial plan to avoid being caught off guard and to prevent your progress from being halted. Starting an emergency fund is one approach to being ready for unforeseen costs. You can utilize the money in your emergency fund, which is a separate savings account, to pay for any unforeseen expenses. By doing so, you can cover that unexpected payment or an urgent car repair without incurring too much debt. Financial professionals often advise putting emergency funds into high-yield savings accounts, enabling you to earn more monthly interest than conventional banks. In this method, even if you aren't making regular donations, your money will still increase faster. 4. Determine what is most practicable for you using your budget. Knowing your expenses and spending patterns is the final and possibly most important piece of advice for creating realistic financial objectives. Then, you can make goals that are suitable for your circumstances. Tracking your expenses and charges may not be particularly comforting, especially if you've never done it before. It's possible that you'll decide to concentrate on this financial goal in 2024 if you've never before made a monthly spending plan. Other strategies include looking over your bank statements and compiling a list of your monthly expenses. As an alternative, you may use a budgeting application like Mint or Empower, formerly Personal Capital, which can connect to your bank accounts, investment accounts, and other financial accounts. Your transactions will be tracked by an automated budgeting tool, which will classify them so you can see what you spend the most money on overall. After that, you can deliberate on where to reduce, or even increase, your expenditure and how to distribute money to reach your new objectives. The power of saving and compound interest. Compound interest is your best friend, and time is your most precious asset when investing. You've come to the right place if you recently started your first job or are beginning a side hustle but are unsure what that compound interest term in the last line means. You're in a terrific position as a young person to start having your money work for you. Why? Since growth quickens with time and you still have a long way to go, saving now will pay off greatly in the long run. Here is all the information you need about compound interest and how to use it to your advantage. What is compound interest? Simple interest must first be understood to understand compound interest. Simple interest solely refers to the interest you receive on your savings. Consider that you want to invest $100. This is your principal balance. You visit the bank and deposit the money into a savings account that offers 1% interest. This means that after having your $100 primary balance in savings for one period, usually a year, you will have earned $1 or 1% on your investment. Since this keeps happening every year, you will receive another 1% or $1 the next year, and so on. That is simple interest. Contrarily, compound interest allows your wealth to increase more quickly throughout your life by paying interest on your principal balance and interest accrued over time. Do you recall studying exponents in school? A related idea is compound interest. Let's return to the first $100. Imagine making a 1% annual compound interest deposit of the same amount into a bank. How does that develop differently from a simple interest rate? Well, it doesn't after the first year. You will still have earned $1 more than your principal balance. But instead of your initial deposit, that $100 principal balance, you will start earning 1% interest on your new account balance of $101 the following year. You earn $1.01 on the amount rather than $1, increasing your account balance to $102.01. That $102.01 gains 1% interest the following year, growing to $103.03. This keeps compounding, or growing, increasing how much you make the following year, the year after, and so forth. How does compound interest work? Compound interest grows ever increasingly since it includes all prior interest that has accrued. The amount of compounding periods or years you have been saving makes a big difference, so you should start saving as soon as possible. You will increase if you deposit money into a compound interest earning account and leave it there. In the preceding illustration, you made a $100 investment and let compound interest take care of the rest. However, if you were to consistently add more money to your principal account balance, for example, every quarter, month, or pay period, your money could truly start working for you. Of course, when you're young and beginning from scratch with your finances, it isn't easy to picture saving money consistently. But doing so has a genuine advantage. From a young age, investing a small sum every month, even just $100, has the potential to grow into a sizable sum of money you can depend on when it's time to retire. How does compound interest actually appear in the real world? Real-world compound interest will look different based on your rate of return, where you invest your money, and how much you save. Consider the following illustration. Investor 1, Charlie, began saving when he was 25. He saved $1,000 monthly for 10 years, up until age 35. He stopped saving after that, but he kept his money in his investment account, which continued to grow at a 1.5% rate until he retired at age 65. Investor 2, Molly, began saving when she was 35. Also, she saved $1,000 monthly for 10 years until she was 45. She did the same as Charlie and kept the money in her investment account, which grew at a 1.5% rate until she was 65. Max, the third investor, started investing at age 45. Like others, he saved $1,000 per month for 10 years before stopping his savings at age 55 and letting his money grow at a 1.5% rate until he was 65. For 10 years, each of the three investors put the same amount, $120,000, into their savings. But when they started saving, their retirement outcomes were very different. In the end, Charlie had $203,105 in savings, compared to Molly's $174,831 and Max's $150,492. Simply put, Compound interest works best when you invest your money early. Which investing strategy is best for me? What should you do with your money now? Compound interest profits may grow even more quickly if you invest in a tax-advantaged retirement account or aren't taxed on the money until you withdraw it in retirement. If you're a full-time employee, the simplest place to start is by making contributions to your employer's 401k, a popular tax-advantaged retirement savings account. You'll have the chance to begin saving for the future as you get older through retirement accounts like IRAs and Roth IRAs. But for now, it could make more sense to talk to an adult in your life about the various savings accounts accessible to you if all you're doing is babysitting after school or working as a lifeguard on Saturdays at the pool. Wintrust can help in this situation. Young investors can access excellent account options from Wintrust, your top community bank, and financial education tools and resources. Wintrust can assist you if you have questions about what is best for you. Through a savings plan suitable for your particular needs, their advisors can assist you in achieving your goals. Connect with a local Wintrust banker to position yourself for the future. Chapter 3. Getting Started with Stocks. When you buy stocks, you bet on the company's long-term success and growth. One of the best ways for novices to learn how to invest in stocks is by making a deposit into an online investment account that can then be used to buy shares of stock or stock mutual funds. For the price of one share of stock, you can start investing by opening a brokerage account. Some brokers also provide paper trading, enabling you to practice trading stocks using stock market simulators before making a real money investment. Exploring different types of stocks. Historically, stock market investing is one of the key routes to financial success. When researching stocks, you'll often hear them described in various stock categories and classifications. These are the main stock types that you need to be aware of. Preferred stock and common stock. Common stock makes up the majority of stock investments. Shareholders of common stock, representing a component of a company's ownership, are entitled to a proportionate share of the asset's value if the business is dissolved. Shareholders of common stock have theoretically limitless upside potential. However, they also risk losing everything if the business fails with no assets left over. Differently, preferred stock grants owners the right to get a specific amount of money back in case of a firm dissolution before common shareholders. Additionally, preferred shareholders are entitled to dividend distributions ahead of common shareholders. Overall, this leads to preferred stock having more in common with fixed income bond investments than standard common stock as an investment. A corporation will often only sell common stock. This makes sense because stockholders typically want to acquire that. Large cap, mid cap, and small cap stocks. The market capitalization of stocks refers to how much money their shares collectively are worth. The largest market capitalizations of firms are called large cap stocks, while successively smaller companies are represented by mid cap and small cap stocks. These groups are not well delineated from one another. However, one frequently used criterion states that equities are considered to be large cap if their market cap is $10 billion or over, mid cap if their market cap is between $2 and $10 billion, and small cap if their market capitalization is under $2 billion. Mid cap and small cap stocks offer higher potential for future growth but are riskier than large cap equities, typically considered safer and more conservative investments. But just because two businesses are grouped here doesn't indicate they are similar investments or will perform similarly in the future. Domestic and foreign stock markets. Stocks can be grouped according to their location. Most investors consider the location of the company's official headquarters to help them distinguish domestic U.S. equities from foreign companies. It's crucial to realize that a stock's geographical classification does not always correlate to the region from which the company derives its sales. A classic example is Philip Morris International, PM 0.34%, which has its headquarters in the United States but sells all its cigarettes and other products completely abroad. It can be challenging to determine a company's true domestic or international status based on business operations and financial data, especially for large multinational businesses. Value stocks and growth stocks. Another categorization technique distinguishes two common investment strategies. Growth investors typically search for businesses whose sales and profitability are rising quickly. Value investors seek out businesses whose stock is undervalued, whether compared to their rivals or historical stock price. Growth stocks often carry higher levels of risk, but the potential rewards can be very alluring. Businesses with high and rising customer demand, particularly concerning longer-term societal changes that encourage using their products and services, are successful growth stocks. However, competition can be severe, and if competitors undermine a growth stock's operations, it may swiftly lose popularity. Investors concerned that long-term growth potential is dwindling can often cause even a slight slowdown in growth to cause prices to drop quickly. Value stocks, however, are thought to be more cautious purchases. They are often established, well-known businesses that have already developed into market leaders and don't have as much room to grow. However, they can be ideal options for people looking for more price stability while still obtaining some of the benefits of exposure to equities because they have dependable business structures that have withstood the test of time. IPO stocks. IPO stocks refer to shares of businesses that have just completed an initial public offering. When a new company goes public, investors who want to invest early in a good business idea are often quite excited. However, they can also be risky, particularly if the investment community is divided over their potential for development and profit. After going public, a stock typically keeps its status as an IPO for at least a year and up to 2 to 4 years. Stocks with and without dividends. A lot of stocks regularly pay dividends to their shareholders. Because dividends offer significant income to investors, dividend stocks are highly prized in several financial spheres. A corporation qualifies as a dividend stock if it pays even 1 cent per share. However, stocks are exempt from dividend obligations. Stocks that don't pay dividends can make solid investments if their prices increase. Even if the trend in recent years has been toward more stocks paying dividend payouts to their shareholders, some of the largest corporations in the world still do not pay dividends. Income stocks. Since most companies give out income in dividends, income stocks are simply another name for dividend stocks. However, shares of businesses with more established business models and relatively fewer long-term growth potential are also called income stocks. Income stocks are popular among individuals in or close to retirement since they are best for conservative investors who want to withdraw cash from their investment portfolios immediately. Non-cyclical and cyclical stocks. National economies often experience expansionary and contractionary cycles, boom times, and busts. Investors refer to certain companies as cyclical stocks because they are more vulnerable to general business cycles. Shares in businesses engaged in manufacturing, travel, and luxury products are examples of cyclical equities because a downturn in the economy might impair customers' capacity to make large purchases swiftly. However, when economies are strong, a surge in demand may cause these businesses to recover quickly. Non-cyclical companies, usually called secular or defensive stocks, don't experience those significant fluctuations in demand. Grocery store companies are an example of non-cyclical equities since people still need to eat whether the economy is doing well or poorly. While cyclical stocks often thrive during strong bull markets, non-cyclical stocks typically do better during market downturns. Safe stocks. Safe stocks have share prices that fluctuate less than the entire stock market on an up and down basis. Safe companies, sometimes referred to as low volatility equities, typically operate in sectors of the economy that are less subject to shifting economic conditions. Additionally, they often provide dividends, and this revenue can be used to counteract declining share values in trying times. Sector-specific stock. Stocks are often categorized according to the industry they are in. Stock market sectors are among the main classifications that are most frequently used. Communication, internet, media, telephone, and leisure service providers. Consumer discretionary, retailers, automakers, hotel and restaurant chains, and other businesses. Consumer staples, food, beverage, tobacco, household, and personal product manufacturers. Energy, firms engaged in the discovery and production of oil and gas, pipeline suppliers, and owners of gas stations. Financial institutions, banks, mortgage lenders, insurance providers, and brokerage firms. Healthcare, medical device manufacturers, medicine and biotech firms, and health insurance. Industrial, railroad, aviation, construction, logistics, aerospace, and defense firms. Materials, mining, forestry, building supplies, packaging, and chemical firms. Real estate, firms that maintain and develop properties as well as real estate investment trusts. Technology, firms that provide hardware, software, semiconductors, communications gear, and IT services. Utilities, electric, natural gas, water, renewable energy, and multi-product utility corporations. ESG stocks. ESG investing is an investment philosophy emphasizing environmental, societal, and governance issues. ESG principles consider additional collateral effects on the environment, business employees, customers, and shareholder rights rather than concentrating solely on whether a firm makes a profit and increases its income over time. Socially responsible investing, or SRI, is linked to the regulations that govern ESG. SRI investors eliminate equities from businesses that don't align with their core beliefs. ESG investing has a more advantageous aspect, though, in that it actively promotes investing in the companies that perform things the best rather than simply rejecting those that fail important tests. The topic is very interesting because research has shown that adhering to ESG principles can increase investment returns. Blue chip stocks. There are stock categories as well, which make decisions based on perceived quality. Blue chip firms are often the best of the best in the corporate world, dominating their respective industries and building solid reputations. Although they normally don't offer the maximum profits possible, investors with lesser risk tolerance choose them because of their consistency. How to invest in stock. Investing is a tried-and-true approach to making money work for you as you try to make more money. Warren Buffett, a famous investor, characterized investing as foregoing consumption now to have the ability to consume more later. You can increase your money several times if you constantly invest your money. Because of this, it's crucial to start investing as soon as you have any money set aside for the purpose. Furthermore, a fantastic place to start is the stock market. You can begin whether you have $1,000 saved or can simply afford an extra $25 per week. Remember that there is a lot you can and should learn about stock investing if you want to succeed financially for the time being. Read on for the procedure to start the process. 1. Establish your level of risk tolerance. What is your risk tolerance, or how willing are you to take the potential of losing money if you invest? Stocks can be divided into several categories, including value stocks, aggressive growth stocks, high capitalization stocks, and small cap stocks. There are varying degrees of risk with each. You can focus your investment efforts on the stocks that complement your risk tolerance once you've established it. 2. Choose your investment goals. Determine your investment goals as well. An online broker like Charles Schwab or Fidelity will ask you about your investing goals and the previously mentioned degree of risk that you're willing to take when you open a brokerage account. An investment goal can be increasing the amount of money in your account if you're just starting your profession. You might desire to make money and build and safeguard your wealth if you're older. Your investment goals can be to save for college, buy a house, or support your retirement. Goals might evolve. Just be careful to identify them and revisit them occasionally so you can stay focused on accomplishing them. 3. Choose an investing strategy. While some investors like to set and forget it, others desire to manage their money actively. Though your choice could vary, choose a strategy to get going. You could manage your investments and portfolio independently if you are confident in your knowledge and abilities in the field. You can invest in bonds, stocks, exchange-traded funds, ETFs, index funds, and mutual funds using traditional internet brokers like the two described above. You can get assistance from a seasoned broker or financial advisor with your investment choices, portfolio management, and portfolio adjustments. This is a wonderful choice for beginners who recognize the value of investing, yet may desire the assistance of a professional. An automated, hands-off alternative to working with a broker or financial advisor, robo-advisors are often less expensive. Your goals, level of risk tolerance, and other information are collected by a robo-advisor program, which then automatically invests for you. 4. Select a trading account. Workplace retirement plan. If your workplace has a retirement plan like a 401k, you may invest via it in various stock and bond mutual funds and target date funds. It might also provide the chance to purchase employer stock. After enrolling in a plan, you automatically contribute at the specified level. On your behalf, employers could make matching donations. Your account balance grows tax-deferred, and your donations are tax-deductible. This is an excellent approach to increasing your investment returns with little work. Additionally, it can teach investors the discipline of consistent investing. A brokerage's taxable or IRA account. Besides having a workplace plan, you can start investing in stocks by creating an individual retirement account. Alternatively, you could choose a standard, taxable brokerage account. You typically have a wide range of stock investment possibilities. Individual stocks, stock mutual funds, exchange-traded funds, ETFs, and stock options may be among them. An account with a robo-advisor. As previously mentioned, an account of this kind builds a stock portfolio for you according to your investment goals. 5. Become more diverse to lower your risk. Understanding diversification in investments is crucial. Simply said, investing in various assets, or diversification, lowers the risk that the performance of one investment will materially impede the return on your entire investment portfolio. It could be interpreted as slang for avoiding putting all your money eggs in one basket. Diversification might be challenging if your budget is tight when investing in individual equities. For instance, you might only be able to invest in one or two businesses with just $1,000. There is a higher risk as a result. Mutual funds and ETFs can be useful in this situation. Both types of funds often hold most stocks and other investments. As a result, they offer greater diversification than a single stock. I hope you are enjoying my audiobook so far. It would be a pleasure if you could let me know how you are feeling about this audiobook in the comments section below. We would greatly appreciate it if you could also like this video and subscribe to United Audiobooks to have access to more best-selling audiobooks in the future. Also, please, if you are interested in getting more free audiobooks, please click the first link in the description below. Now, let us carry on with the next chapter. Chapter 4: The World of Index Funds. Investors' concerns about the ability of fund managers to produce the best returns on their mutual fund investments are driving them to choose passively managed products, such as index funds, more and more. Before you contemplate investing in index funds, this chapter will provide you with all the information you need about them. What is an index fund, and how does it work? An index fund is a mutual fund that invests in stocks that closely resemble those in a specific market index. This suggests that the scheme's performance will be consistent with the benchmark index it monitors. An index is a collection of securities that characterizes a specific market sector. Index funds are considered passive fund management since they follow a certain index. The traded securities in a passively managed fund are based on the underlying benchmark. Additionally, passively managed funds do not need a professional group of research specialists to spot opportunities and select the best stock. An index fund is created to replicate the performance of its index, as opposed to an actively managed fund that works more and harder to time and outperforms the market. As a result, the returns of index funds match those of the underlying market index. Except for a little variation known as tracking error, the returns are roughly equivalent to the benchmark. The fund management often makes an effort to minimize this inaccuracy. Advantages of buying index funds. The following are some benefits that index funds enjoy. 1. Low costs. An effective staff of research analysts is unnecessary to help fund managers select the best companies because an index fund mirrors its underlying benchmark. Additionally, there is no active stock trading. All of these elements result in an index fund's minimized managing costs. 2. Unbiased investment. Index funds invest via an automated, law-based process. The fund manager's mandate specifies the amount to be invested in index funds of different securities. By doing this, human judgment or prejudice in making investment decisions is eliminated. 3. Widespread exposure. To guarantee that the portfolio is spread across all stocks and industries, investments should be made in a ratio similar to that of an index. An investor can therefore utilize a single index fund to collect the probable returns on the larger market sector. If you invest in a Nifty index fund, you can access 50 securities distributed over 13 industries, from pharmaceuticals to financial services. 4. Tax advantages of index fund investing. Index funds often have a minimum turnover or few trades made by a fund manager in a given year due to their passive management. Less trading results in fewer capital gains and dividends being paid to unit holders. 5. Easier to control. Index funds are easier to manage since fund managers don't have to stress about how the market treats the stocks that comprise the index. All a fund manager needs to do is periodically rebalance the portfolio. Who should invest in index funds? When choosing mutual funds, your investing horizon, goals, and risk tolerance should all be considered. Risk-averse investors should use index mutual funds. Such funds don't need in-depth investigation and tracking. For instance, You can choose a Sensex or Nifty index fund if you want to invest in stocks but do not want to expose yourself to the risks of actively managed equity funds. What things should you consider as an investor? Before choosing to invest in index funds, you should think about the factors listed below. 1. Returns on index funds. Index funds seek to match the market index's performance. They do not strive to outperform actively managed funds' benchmarks. Due to tracking issues, the returns generated could occasionally fall short of those of the underlying index. The index fund will perform better the lower the errors are. 2. Risk-taking. Index funds are less vulnerable to risks and volatility associated with equities because they represent a specific market index. It makes sense to invest in index funds to get the best returns during a market upswing. However, because index funds often lose value during a slump, things might become ugly. Therefore, a mix of actively and passively managed index funds in your portfolio is always advisable. 3. Investment costs. The expense ratio for index funds is naturally 0 less than actively managed funds. The fund manager is not required to develop an investment strategy for index funds. Even a fund with a lower expense ratio should be remembered that it has the potential to produce larger returns on investment. 4. The taxing. Redeeming the units of your index fund investment results in capital gains, which are taxed. The holding period, or time you remain invested, determines the tax's rate. Gains with a holding period of up to 1 year are termed short-term capital gains, STCG, and are subject to a 15% tax, plus any relevant surcharge and 4% health and education. Suppose the total long-term capital gains amount from equity-oriented mutual funds/equity shares exceeds $100,000 in a year. In that case, long-term capital gains, LTCG, from funds held for more than 12 months can lead to long-term capital gains tax at 10%, plus surcharge where applicable, plus 4% health and education. 5. Investment time frame. Index funds are subject to large changes quickly. If these variations persist for a long time, they might even out the returns on your investment. Therefore, index funds are the best choice for investors with a lengthy time horizon. If you choose to buy index funds, you must have the patience to wait for the fund to reach its full performance potential. How to invest in index funds. An index fund adheres to a market index, which is often made up of stocks or bonds. Typically, index funds invest in every element that makes up the index they follow, and they have fund managers whose job is to ensure that the index fund performs identically to the index. Choose an index. With the use of index funds, you can follow countless different indexes. The S&P 500 index has 500 of the best businesses on the American stock market and is the most well-known. Here is a list of a few more prominent indexes, organized by the market segment they cover. Bonds. Bloomberg Barclays Global Aggregate Bond. International stocks. MSCI Emerging Markets, MSCI EAFE. Small U.S. stocks. S&P Small Cap 600, Russell 2000. Large U.S. stocks. Dow Jones Industrial Average, S&P 500, NASDAQ Composite. In addition to these broad indexes, sector and country indexes focus on stocks in particular industries, style indexes highlight fast-growing businesses or undervalued stocks, and other indexes restrict investment based on their filtering mechanisms. 2. Pick the appropriate fund for your index. You can typically locate at least one index fund that follows your chosen index. You may have a dozen options for tracking well-known indexes like the S&P 500. Ask some fundamental questions if you have more than one index fund option for your selected index. First, which index fund, first, closely mirrors the index's performance? Second, which index fund has the lowest fees? Third, can you invest in an index fund despite its restrictions or limitations? Finally, are any further index funds offered by the fund provider that you'd want to use? Choosing the ideal index fund for you should be made easier by the answers to those questions. 3. Get shares of index funds. You can register a brokerage account to buy and sell the index fund shares you want. On the other hand, you can open an account directly with the mutual fund provider. Once more, it pays to consider features and expenses when determining how to purchase index fund shares. Registering a fund account directly through the index fund firm is less expensive because some brokers charge extra for their clients to purchase shares of index funds. However, many investors hold their interests in a single brokerage account. The brokerage option may be your best option to consolidate all your investments under a single account if you want to invest in various index funds offered by various fund managers. Chapter 5. Navigating the Options Market. Contracts known as options grant the buyer the right, however, not the obligation, to buy or sell the asset at a particular price on a particular date. They are called derivatives because the underlying asset gives them their value. Trading options is a strategy traders employ to speculate, generate income, and reduce risk. Despite its daunting appearance, options trading delivers substantial gains that cannot be achieved solely by trading shares and ETFs. Trading options involves making predictions movement of the market or share price. Before understanding how to trade options, let's understand how options trading works. How does options trading work? In options trading, traders can purchase a call option if they are bullish about the market and a put option if they wish to wager on dropping prices. Traders who purchase call options set a price at which they will purchase the shares later. In contrast, traders who purchase a put option will decide the price at which they will sell the shares later. Trading options is a cheap technique to predict an asset's market or share price. This is because traders will have the right, but not the obligation, to fulfill the contract as a buyer of a call or put option. Traders must decide not to exercise their rights if the contract is not profitable on the expiration day. They would only lose out on the premium in this scenario. To bet on the markets growing or decreasing and promptly pocket the premium money, traders can also sell the call or put option. However, they must uphold their end of the bargain when they sell. Traders can purchase both call and put options to profit immediately. Each possible combination of buying and selling possibilities is a strategy. Types of options trading strategies. Every trader needs to be familiar with the options trading strategy listed below. Bull call spread is a bullish technique where the trader purchases one call option and then sells another with the higher strike price. He has a bullish outlook on the market and stands to gain if the price of the underlying securities increases. Bull put spread. In this strategy, the trader will buy a put option and sell a different put option with a higher strike price. When the value of the underlying security rises, the trader will profit. Protective put versus synthetic call. In a synthetic call, the trader purchases both the underlying asset and a put option. If the asset price increases, earnings are infinite. If it decreases, losses are only as great as the premium paid for the put option. Bear call spread. This bearish trading method entails purchasing one call option and selling another with a lower strike price. Profits are only realized when the asset's price declines. Both the earnings and the losses in this technique are constrained. Bear put spread. When traders anticipate a slight decline in the markets, they buy a put option and sell a different option with a lower strike price. Profits and losses are constrained. Profits result from a decline in asset price. Protective call versus synthetic put. When the markets decline, the trader benefits from a synthetic put or protective call. This approach combines purchasing a call option while holding a future short position. When the price drops, the profit is limitless, and the loss is only as great as the premium. Long and short straddle. A market-neutral trading strategy known as a long or short straddle combines call and put options with the same strike price. A long straddle offers limitless rewards and no risk. A short straddle, in contrast, offers infinite loss, and rewards are restricted to the premium collected. Long and short strangles. In a long strangle, the trader will purchase a call option with a greater strike price than a put option. Profits are limitless, and losses are only as great as the premium paid. Selling a call with a greater strike price than the put is known as a short strangle. The loss is limitless, and the profit is only as much as the premium. Long and short butterfly. A long and short strategy that combines bullish and bearish spreads while capping gains and losses at a certain amount. It is a balanced strategy with set risks and profits that are capped. Advantages of trading options. Excellent hedging tools. Options are effective hedging tools, but one must utilize them properly. Using options, traders can lower their equity downside risk. For instance, if a trader owns shares in a firm and is concerned that the price will decline, they can purchase a put option to reduce the risk of a decline. Cost-effective. Because options are contracts for underlying assets and do not represent ownership, they are less expensive than stocks. For instance, a trader would need to invest $10,000 to buy 100 company shares with a $100 share price. However, they can purchase a contract for 100 shares of options for just $500. Traders can make significant profits on their bets by using the remaining funds as they see fit. Short-term potential for higher returns. Options provide a greater potential for short-term superior returns than equities. The trader must, however, employ the appropriate strategies. The profit percentage is larger in options because traders spend less money using options and make earnings practically identical to those made in equities. The disadvantages of trading options. Trading options include 3 decisions: direction, time, and price, which can make it very difficult. Before implementing an option strategy, traders must consider all 3 factors. Uncertainty of gains. Gains are uncertain because all option strategies are based on assumptions and future expectations. Only when the share prices move in the direction the trader forecasted will the trader profit. Losses are likely if this does not happen. Trading commissions and fees. Compared to trading in equities, options trading entails hefty trading charges and costs. The costs rise as the strategy becomes more complicated and includes more calls and puts. Tax. Because all gains from trading options are short-term, they are subject to the 15% short-term capital gains tax. As a result, the trader loses some of those gains to taxes. Things to keep in mind when trading options. Losses. When trading options, a small margin is invested, less than the money required to purchase the shares. This can cause traders to lose sight of the size of their potential losses if the market doesn't move in their favor. Liquidity. Having an exit strategy is essential when trading options. Trade just the options that have a lot of liquidity. Otherwise, there is a risk that funds would freeze and that there will be losses. Although a cheap choice may seem appealing, it is often less liquid than a costly one. Therefore, it's crucial to balance profitability, accessibility, and liquidity. Hedging. At first, options trading might be very perplexing. To reduce risk and better understand how options work, beginners must combine options with a standard trade. It is preferable to use options for hedging purposes first. It should ideally only be used by seasoned traders to speculate and profit. Option strategies are most important when the traders wish to hedge, speculate, or profit. Making money and reducing risk both require employing the appropriate method. How to trade options. The basic steps in the trading of options are listed below. 1. Your goal should be decided. Whatever your trading goal, you'll need a brokerage account authorized to trade options to proceed with any option strategy. Your exact degree of options approval will also affect the trades you can make. 2. Find options and ideas. What other qualities of an option or underlying security are you seeking now that you've determined your main goal? The universe of trades can be reduced to a manageable number of possibilities by filtering the field based on price, volume, implied volatility, sector, and other criteria. 3. Compare and analyze ideas. It's time to contrast your options and trade ideas when you've found a few. Start by evaluating each option's possible risks and rewards and how its price may be influenced by variables, including changes in the underlying stock price, days till expiration, various strike prices and expiration dates, and implied volatility. 4. Put in a trade for options. Have you decided which option to trade? The next step is to place an online order to build your option position. Enter the relevant option order information, type, expiration, strike price, number of contracts, etc., after selecting the underlying symbol. Your order will be sent to the market when it has been submitted. 5. Controlling your position. Once your options position has been established, opened, it is advisable to monitor it to determine what to do as expiration draws closer by looking at its value and trend. If you purchased an option, you may sell it before it expires, exercise it, buy or sell the underlying securities, or let the option expire worthless, depending on the underlying asset's price. You have 2 options if you sold an option: either buy it back to close the position or let it expire worthless. Additionally, you can be forced to take assignments if you purchase or sell the underlying security. Chapter 6. The Rise of Cryptocurrencies. Over the past few years, cryptocurrencies have grown in popularity. As of 2018, there were more than 1,600 of them. Additionally, the number keeps rising. As a result, there is a rise in demand for blockchain developers who create software that powers cryptocurrencies like Bitcoin. Blockchain developers are highly regarded, as evidenced by their wages. A full-stack developer makes an average income of more than $112,000, according to Indeed. Even a dedicated website for cryptocurrency jobs exists. Whether you're interested in a job as a blockchain developer or just want to stay up to date with the current developments in technology, here we will explain what cryptocurrency is and why it's important and get you off to a good start. What is cryptocurrency? A cryptocurrency is a coded string of information representing a unit of exchange. Blockchains are peer-to-peer networks that act as secure transaction ledgers while keeping track of and organizing Bitcoin transactions, like transferring, buying, and selling. Cryptocurrencies can act as both money and an accounting system. A cryptocurrency is a type of virtual or digital money used as a means of transaction. It is very similar to real money, except that it uses encryption instead of having a tangible form. Since no central bank or body controls how cryptocurrencies operate, additional units can only be introduced if certain requirements are satisfied. For instance, fresh Bitcoins can only be created with Bitcoin when a block is uploaded to the blockchain. At this point, the miner is paid in Bitcoins. After the 21 millionth Bitcoin is created, no more will be made. How does cryptocurrency work? Cryptocurrency is a virtual/digital currency that utilizes cryptography for security. This security feature makes cryptocurrencies challenging to counterfeit. Since they are decentralized, cryptocurrencies are not controlled by any one organization, such as the state or financial institutions. Additionally, distributed ledger technology, typically a blockchain, which serves as a public database of financial transactions, allows for the decentralized control of each coin. In 2009, the cryptocurrency known as Bitcoin was developed. The process of creating a cryptocurrency is called mining. This involves using computing power to solve difficult mathematical puzzles that validate transactions on the blockchain, the open ledger of all cryptocurrency transactions. And in exchange for their work, miners receive cryptocurrency. Trading cryptocurrencies are complex and speculative, and there are big risks involved. Prices are subject to change at any time. Only select investors should invest in cryptocurrencies due to their price volatility. As a result, investing in cryptocurrencies should be regarded as high risk. Know the risks associated with investing before deciding, and seek financial advice. Benefits of cryptocurrency. The cost of a cryptocurrency transaction is negligible or non-existent, as opposed to, for instance, the cost of sending money from a digital wallet to a bank account. Transactions are not time-limited and are unrestricted for both purchases and withdrawals. Additionally, unlike opening a bank account, anyone can use cryptocurrencies, which necessitates papers and other documentation. International cryptocurrency transactions are even faster than wire transfers. Wire transfers take almost a day to move money between locations. Cryptocurrency transactions are finished in a few minutes or even seconds. How to buy cryptocurrency. As said earlier, cryptography is used by cryptocurrencies to protect their transactions and control the production of new units. Cryptocurrencies are digital or virtual tokens, and fiat money, or conventional currencies like the US dollar or euros, is often used to purchase cryptocurrencies. However, cryptocurrencies like Bitcoin or Ethereum can also be used to pay for them. You must initiate a digital wallet to save your funds to purchase cryptocurrencies. Then, you can purchase coins on a cryptocurrency exchange using your fiat money or another cryptocurrency. There are several options for purchasing cryptocurrencies. To purchase Bitcoin with a credit/debit card, bank transfer, or other payment method, utilize an online cryptocurrency exchange like Coinbase, Binance, or Kraken. You can buy cryptocurrencies directly from other users through a peer-to-peer exchange like Local Bitcoins or BISC. Using cryptocurrency trading platforms, you may exchange cryptocurrencies for different assets, like stocks. How to store cryptocurrency. Investing in cryptocurrencies requires secure cryptocurrency storage. There are various ways to store cryptocurrency, but a digital wallet is the most popular. Software-based, web-based, or hardware-based digital wallets are all possible. Web-based wallets are accessed using a web browser, but software-based wallets must be installed on a computer or mobile device. A physical device that stores cryptocurrency offline is a hardware-based wallet. Cryptocurrency is kept, sent, and received using digital wallets. They are generally less vulnerable to malware and hacking than other wallets. However, digital wallets can be recovered or stolen if not properly protected. To protect the wallet, utilizing two-factor authentication and strong passwords is crucial. Additionally, Avoiding address reuse and other security problems can be achieved by utilizing an address produced by a secure random number generator. Additionally, it is best to keep your private key, which has access to your cryptocurrency, confidential. How to invest safely in cryptocurrency. Before investing in cryptocurrencies, conducting market research and understanding the industry is essential. Recognizing the technologies, advantages, and risks of investing in cryptocurrencies. Use reputed exchange platforms. Investors should only buy and sell cryptocurrencies on reputable exchanges. Reputable exchange platforms have safety features to shield investors from fraud and theft. Store cryptocurrency securely. After obtaining cryptocurrency, it is essential to store it safely. Investing in a secure wallet is one of the greatest methods to safeguard cryptocurrency against theft and fraud. Diversification. Investment diversification can help reduce the risks of making Bitcoin investments. For instance, disperse the threat by purchasing many cryptocurrency types. Chapter 7. Investing in Real Estate. Although high interest rates might deter investors from buying real estate, they are predicted to flood the market again once rates start to decline. In a recent bank rate research, 29% of Americans said they would put their money in real estate if they knew they wouldn't need it for at least 10 years. Beyond becoming a landlord, a well-established option for those who prefer to manage a property personally, consumers have various options for investing in real estate. The ability to invest in real estate without having tens of thousands or more in cash is also made easier than ever before by new business platforms. Benefits of real estate investing. One of the most popular and profitable investments, real estate has a lot of success potential when done properly. One advantage of real estate investing is a steady income stream that could potentially result in financial independence. Passive income generation is possible. You can produce passive income that is almost tax-free by investing in real estate. Even while sleeping, your rental properties will continue to earn you money. You can spend less time working and more time doing what you enjoy if you invest in several rental properties that bring in enough money to pay your expenditures. It can provide retirement cash flow. When done properly, real estate investing is a great way to build wealth over time. Generating income flow for retirement is one of the numerous advantages of real estate investing. This means you might use the money from your rental properties to supplement your retirement income. Hedge against inflation. Real estate investors do not share the dread of inflation that most people do. Property investment is a great way to protect against inflation. Your property's rental income and the values of your investment both increase when the price level does. Thus, the short-term and long-term effects of inflation are shielded from real estate investors. Real estate is a stable investment with ongoing income. Real estate investments do not vary drastically daily, like investments in the stock market. It is a reliable investment that generates revenue for you. You only periodically collect your ongoing income, also known as cash-on-cash return, to sell when the price has significantly risen and the market is strong. You can help others by having a home. The satisfaction of giving someone else a home is an underappreciated advantage of real estate investing, particularly in residential real estate. Everyone needs a place to live, but not everyone has the money up front to buy a house, leaving renting their only choice. We often hear stories about landlords neglecting their duties and providing certain renters with nightmare-like living situations. Investment in residential real estate guarantees that a family is housed in safe, healthy, clean, and equal conditions in addition to assisting with housing necessities. For investors, real estate investing offers a variety of alternatives. You have the option of investing in single-family homes, multifamily homes, vacant land, and commercial buildings, depending on your initial startup finances, leverage, and preferences. Even if you lack experience, you can start investing in real estate as soon as you have the funds or resources to purchase a home. Longer leases are an advantage of investing in commercial real estate. This is because they can give you more stability and dependability. This is so that they may stay in one place for longer, which is what most businesses desire to do. Real estate is never worthless. Aside from the fact that real estate values often increase, your investment in real estate can never lose value, even in trying times. We think that if you own a home, you can always sell it. Unlike stocks, real estate never loses value, even when its value declines. Real estate investment reduces risk. One of the main pros of using real estate in one's financial portfolio is risk minimization. Yes, having a steady monthly paycheck is a huge benefit, but protection against riskier investments like stocks is often crucial. Real estate investing has many benefits and is a great method to earn passive income. Due to the increased demand for houses, real estate values often rise, increasing your chances of success. Real estate investing has other significant advantages besides financial ones. See the benefits of real estate investing to understand why this will make a fantastic addition to your portfolio. Investing in real estate in 2023. The increase in interest rates has had a significant impact on the housing market. Because rising rates make homes less affordable for borrowers, owners may need to drop their asking prices to sell a property, as they did for most of 2022 and the beginning of 2023. Interest rates were still relatively low at the beginning of 2022. Mortgage rates were considerably higher than in 2021, but the Federal Reserve had not yet swiftly raised interest rates. However, the central bank had clarified that it was preparing to raise rates considerably in the coming months. Smart buyers, therefore, sought to lock in reduced mortgage rates on their real estate acquisitions. The Fed then began raising interest rates at an unprecedented rate. Real estate has become less accessible due to the rate rises, and many property sellers have decreased prices. The average 30-year mortgage rate was just under 7% in early 2023, a record high. But individuals considering getting involved should remember that real estate investing is often a long-term endeavor. Even if interest rates are high now, it might be best to start saving money for a down payment while awaiting a rate decrease. In light of that, here are the top 5 strategies to invest in real estate. 1. Purchase your own home. While you would not typically consider your first home an investment, many others do. It provides several advantages and is among the greatest options for investing in real estate. Your monthly payments can be used to build equity in your property rather than paying rent, which always seems to increase yearly. Some of the monthly mortgage payments you make go into your pocket. However, there is still disagreement among experts regarding the advantages and disadvantages of home ownership, and as homebuyers in the 2000s learned, a house is never a prudent investment. If you want to live there for an extended period of time, buying a home can make sense because you'll be able to lock in a monthly payment that may be comparable to what you would pay in rent. Additionally, banks provide borrowers with a cheaper mortgage rate and lower down payment requirements for owner-occupied residences, showing them more favorably. Interest costs may also be deductible from your taxes. 2. Make an investment in a house to rent out. You may try renting out a duplex or a single-family home as a residential property if you're ready to take things a step further. The fact that you are aware with the needs of the market makes this sort of property superior to commercial properties like retail centers. A single-family home can be a good place to start small and with little investment. For a home property, you might buy it for $20,000 or $30,000 instead of the hundreds of thousands required to buy a commercial property. If you can locate a desirable distressed property through foreclosure, you might be able to purchase it even more affordable. You'll need to put down a sizable sum as a down payment, often as much as 30% of the purchase price. Therefore, it can be prohibitive if you're just starting and don't have a sizable bankroll yet. It could be possible to get around this by purchasing a rental home where you also reside. Another drawback is that you'll have to manage the property and decide, for example, what needs upgrading. Even while owning property is viewed as a passive occupation for tax purposes, being a landlord may make it anything but that. Additionally, even if a tenant skips a payment, you must continue making monthly installments to avoid defaulting on the loan. 3. Consider house flipping. House flipping has grown in popularity, but demands a good sense of value and more operational know-how than being a long-term landlord. If you follow this route properly, you could make money more quickly than if you were a landlord. The major benefit of using this strategy is that you can make money more quickly than simply managing your property, but it also requires more experience. House flippers typically identify undervalued homes needing repairs or a complete renovation. The difference between their all-in pricing, buy price, rehab costs, etc., and the sales price is what they profit from after making the necessary repairs and charging market value for the homes. House flippers require a keen eye for what can be mended affordably and what cannot. A house's potential future value must also be estimated. If they make a mistake, their profit could disappear fast or, worse yet, become a complete loss. If a house doesn't sell immediately, the house flipper may be stuck paying interest on the loan until a buyer is found. 4. Purchase a REIT. The next two real estate investment strategies are passive, contrasting the earlier choices. REITs, real estate investment trusts, are a perfect choice for investors who desire real estate profits with liquidity and ease of stock ownership. Additionally, you are entitled to a dividend. Compared to conventional real estate investing, REITs offer several benefits and could simplify the process considerably. However, purchasing REITs has drawbacks of its own. A REIT's price may change when the market swings, just like the price of any stock. As a result, REIT prices could decrease along with the market. This is less of an issue for long-term investors who can weather a downturn, but if you need to sell your stock, you cannot get what it's worth right now. You must thoroughly analyze any REIT equities you intend to purchase using methods appropriate for professional analysts. However, purchasing a REIT fund, which owns a variety of REITs and thus diversifies your exposure to any one business or industry, is one method to avoid this drawback. With a little money, investing in a REIT is a fantastic place to start, but you'll need to put in some effort since there are still some ways to lose money on a REIT investment. 5. Use a real estate website. You may get into real estate on larger commercial ventures using an online real estate platform like Fundrise or CrowdStreet without investing hundreds of thousands or even millions of dollars. These platforms assist in bringing together investors and developers eager to finance real estate and profit from potentially pretty lucrative profits. The main benefit for investors in this situation is the possibility of participating in a rich venture they might not otherwise have been able to access. Depending on the deal's details, investors may be able to participate in either debt or equity investments. These investments could generate returns unrelated to the economy and cash payments, allowing investors to spread their exposure to market-based assets across their portfolios. However, there are several drawbacks to these sites. Some may not even be useful if you don't already have money because they may only accept accredited investors, such as those with a net worth of $1 million or more. However, while some platforms could demand a minimum investment of $25,000, others can get you in with just $500. The platforms also levy an annual administration fee, commonly 1%, and they may tack on additional charges. That can seem expensive in a world where mutual funds and ETFs can build diverse portfolios of stocks and bonds for as little as 0% commission. While platforms may screen their investments, you will also need to do so, which calls for the ability to examine the opportunity. The investments may have low liquidity and offer few opportunities for redemption until a particular project is finished. And unlike investments in a REIT or your rental property, you might need to locate another contract once a deal is finished and your investment is repaid to keep your portfolio expanding. Chapter 8. Managing Risk in Your Investment Portfolio. Financially, a risk is the possibility that a result or investment won't produce the desired results or return. Risk implies the possibility of losing the entire initial investment or a portion of it. Risk is typically quantified by taking past actions and results into account. Standard deviation is a common metric used to measure risk in finance. The standard deviation calculates how volatile asset prices are with their average historical values over a specific period. Understanding the fundamentals of risk and how it is quantified makes it possible and smart to control investment risks. All types of investors and business managers can prevent unnecessary and expensive losses by becoming aware of the risks that can apply to various scenarios and some of the holistic management techniques for managing them. The principles of risk. Everyone faces everyday risks, whether driving, crossing the street, investing, capital planning, or other activities. The most important variables for individual risk management and investment management are an investor's personality, lifestyle, and age. Their risk profile determines each investor's willingness and resilience to risk. Investors typically anticipate bigger profits to make up for increased investment risk. The link between risk and return is a cornerstone concept in finance. The potential return increases with the level of risk an investor is willing to accept. Investors must be paid for taking on greater risks because risks can manifest in many ways. For instance, a corporate bond offers a lesser rate of return than a U.S. Treasury bond, which is one of the safest investments. Compared to the U.S. government, a corporation is significantly more likely to file for bankruptcy. Investors are given a greater rate of return on corporate bonds due to the higher default risk. As said earlier, risk is typically quantified by taking past actions and results into account. Standard deviation is a common metric used to measure risk in finance. A value's standard deviation can be used to gauge its volatility with its historical mean. A high standard deviation denotes a high degree of risk and a high degree of value fluctuation. To help manage risks related to their investments and business operations, people, financial advisors, and businesses can all adopt risk management plans. Several theories, metrics, and management techniques have been found in the academic world to measure, assess, and manage risks. Standard deviation, beta, value at risk, VAR, and the capital asset pricing model, CAPM, are a few of them. Investors, traders, and business managers can often reduce some risks by utilizing various strategies, such as diversification and derivative positions, after measuring and quantifying the risk. Riskless securities. No investment can be completely risk-free, but some assets have so little actual risk that they are considered risk-free or riskless. Riskless securities often form a baseline for risk analysis and risk measurement. These investment options provide an anticipated rate of return with minimal or no risk. All types of investors often turn to these securities to retain funds that must be promptly available or preserve emergency savings. CDs, government money market accounts, and U.S. Treasury notes are risk-free investments in securities. Generally speaking, the baseline, risk-free security for financial modeling is a 30-day U.S. Treasury bill. Given its relatively short maturity date and full faith and credit of the U.S. government, it has little interest rate vulnerability. Risk and time horizons. Investments, time horizons, and liquidity often influence risk assessment and risk management. Investors who require their money to be available immediately are more inclined to put their money in risk-free securities and are less likely to invest in high-risk or investments that can't be immediately liquidated. Time horizons will also be crucial to any investor's investing portfolio. Younger investors may be more likely to invest in greater risk assets with larger potential rewards if they have longer time horizons till retirement. Due to their increased need for funds, older investors would have different risk tolerance. Types of financial risk. Every investing and saving decision carries a unique set of risks and rewards. Investment risks that impact asset values are often divided into two categories by financial theory: systematic risk and unsystematic risk. Investors are, generally speaking, exposed to both systematic and unsystematic risks. Systematic risks, usually referred to as market risks, are risks that could have an impact on the majority of the market or the entire economy. Market risk is the possibility of losing money on investments because of political and macroeconomic risks that impact the market's performance. It is difficult to reduce market risk through portfolio diversification. Interest rate risk, inflation risk, currency risk, liquidity risk, nation risk, and socio-political risk are some additional prevalent categories of systematic risk. Unsystematic risk, usually referred to as specific or idiosyncratic risk, solely impacts one sector of the economy or specific business. The risk of losing money on an investment because of a company or industry-specific risk is known as unsystematic risk. Examples include a product recall, a change in management, a change in regulations that could hurt a company's sales, and the entry of a new competitor with the potential to steal market share from an existing firm. Diversification is a strategy investors use to control unsystematic risk by investing in various assets. There are various other categories of risk in addition to the general systematic and unsystematic risks, including business risk, the basic viability of a business, the question of whether a firm can make enough sales and earn enough income to cover its operating costs and turn a profit, is referred to as business risk. Business risk concerns all the additional costs a business must pay to continue operating and functioning, whereas financial risk concerns financing costs. Salaries, production costs, facility rent, office, and administrative charges are some of these costs. The cost of goods, profit margins, competition, and the overall level of demand for the goods or services a firm provides all impact the organization's business risk. A business risk, known as operational risk, can be related to system failures, human error, fraud, or other internal operations that could negatively affect a company's financial performance. Operational risks can be controlled by implementing efficient internal protocols, procedures, and systems. Businesses and investments may be subject to legal risks resulting from amendments to the law, new rules, or court cases. Legal and regulatory risks can be addressed through compliance programs, keeping an eye on changes to rules, and getting legal counsel as necessary. Default or credit risk. Credit/default risk is the likelihood that a borrower won't be able to fulfill its loan commitments, including paying the contractual interest or principal. Bond investors are particularly concerned about this risk because they own bonds in their portfolios. The last level of default risk, and hence the lowest returns, are associated with government bonds, particularly those issued by the federal government. On the other hand, corporate bonds typically have the largest default risk and the highest interest rates. Investment-grade bonds have a low probability of default, whereas high-yield or trash bonds have a larger probability. Bond rating organizations like Standard & Poor's, Fitch, and Moody's can be used by investors to distinguish between investment-grade and trash bonds. Country risk. Country risk is the possibility that a nation won't be able to fulfill its financial obligations. All other financial instruments in a country and other nations with which it has relations can perform poorly when that country defaults on its debts. Stocks, bonds, mutual funds, options, and futures issued in a certain nation are subject to country risk. The countries with the biggest deficits or emerging markets are more likely to experience this risk. Exchange rate risk. When making investments in other countries, one must take currency exchange rates into account because they might influence how much an asset is worth. Foreign exchange risk, exchange rate risk, is a risk that applies to any financial instruments that are denominated in a currency other than your home currency. For instance, even if you live in the United States and buy in a Canadian stock with Canadian dollars, you could still lose money if the value of the Canadian dollar declines relative to the value of the American dollar. Interest rate risk. Interest rate risk refers to the potential for a change in an investment's value as a result of altering the yield curve's shape, changing the absolute amount of interest rates, the difference between two rates, or any other relationship between interest rates. This type of risk, which has a more direct impact on bond values than stock prices, poses a significant danger to all bondholders. On the secondary market, bond prices are falling as interest rates climb. Reinvestment risk is linked to interest rate risk. There is a possibility that an investor won't be able to reinvest the cash flows from an investment at the same rate of return as the initial investment, such as interest or dividends. Reinvestment risk is crucial for fixed income investments like bonds since they are vulnerable to trends in changing interest rates. Investors can reduce reinvestment risk by diversifying their portfolios, laddering their investments, or choosing various maturity dates. Political risk. Political risk is the possibility that the profits of an investment could be negatively impacted by political unrest or changes in a nation. This risk may result from a shift in the executive branch, the legislature, other foreign policy decision-makers, or military command. The risk, also called geopolitical risk, increases in importance as an investor's time horizon lengthens. Counterparty risk. Counterparty risk is the possibility or likelihood that one of the parties to a transaction could breach a legal commitment. Credit, investment, and trading transactions may be subject to counterparty risk, particularly if they take place in over-the-counter, OTC, marketplaces. Counterparty risk is present in financial investment products such as stocks, options, bonds, and derivatives. Liquidity risk. The liquidity risk relates to an investor's capacity to sell their investment for cash. Investors typically demand a premium for illiquid assets to make up for the time they have had to keep securities that are difficult to sell. Model risk. This risk results from using financial models to assess risks, price financial instruments, or make investment decisions. Model risk can appear if the model is founded on false premises, flawed information, or flawed techniques, which could result in inaccurate projections and unfavorable financial repercussions. Model risk can be controlled by regularly evaluating and analyzing financial models and employing several models to cross-check results and projections. Risk versus reward. The risk-return trade-off balances the desire for the lowest risk and the best profits. Generally speaking, high levels of risk are linked to high potential returns, while low levels of risk are linked to low potential returns. Each investor must determine the level of risk they are prepared and able to take in exchange for the desired return. Based on variables including age, income, investment objectives, liquidity requirements, time horizon, and personality. It's crucial to remember that increased risk doesn't always translate into bigger rewards. The risk-return trade-off suggests that investments with larger risks may result in better profits, but it makes no guarantees. The risk-free rate of return, or potential rate of return on a risk-free investment, is on the lower end of the risk spectrum. It represents the rate of interest you might anticipate from a completely risk-free investment over a certain time frame. Theoretically, you should anticipate receiving the risk-free rate of return as the minimal return on any investment because you wouldn't take on further risk unless the possible rate of return were higher. Risk and diversification. Diversification is the most basic and efficient method of reducing risk. The principles of correlation and risk are important to the diversification process. A well-diversified portfolio will include a variety of securities from various industries with variable levels of risk and return correlation. Diversification is the most crucial factor in assisting an investor in achieving long-term financial goals while reducing risk, even though most investing specialists concur that it cannot guarantee against a loss. Planning and ensuring proper diversification can be done in several ways, including diversify the investment vehicles in your portfolio, such as cash, bonds, mutual funds, ETFs, equities, and other types of funds. Look for investments whose returns historically haven't fluctuated in the same way or to the same extent. Thus, even if a portion of your portfolio loses value, the rest can still increase. Keep your investments diverse within each category. Include securities that differ according to market capitalization, geography, industry, and sector. Combining several types, such as growth, income, and value, is also smart. Bonds should also take into account various maturities and credit characteristics. Include securities with different risk levels. There is no requirement that you choose solely blue-chip stocks. In actuality, the reverse is true. Selecting assets with various rates of return will ensure that significant gains balance out losses in other areas. Keep in mind that diversifying your portfolio is a continuous process. Businesses and investors do routine, checkups, or rebalancing to ensure that the degree of risk in their portfolios is consistent with their financial strategy and goals. Can portfolio diversification offer risk protection? Portfolio diversification is a useful tactic for controlling unsystematic risks related to particular businesses or industries, but it is unable to guard against systematic risks that have an impact on the whole market or a significant portion of it. Diversification cannot eliminate systematic risks like interest rates, inflation, and currency risks. However, by considering additional strategies like hedging, investing in assets that are less linked with the systematic risks, or modifying the investment time horizon, investors can still lessen the impact of these risks. How do risk-taking and investment decisions differ depending on investor psychology? Risk-taking and investment decisions are significantly influenced by investor psychology. Investment decisions made by individual investors may be influenced by their perceptions of risk, past experiences, cognitive biases, and emotional responses. For instance, loss aversion is a cognitive bias that causes people to be more sensitive to prospective losses than gains. Loss aversion can cause investors to be too cautious and steer clear of riskier investments that could yield better returns. Investors can make more educated and logical decisions about their risk tolerance and investment strategy by being aware of their psychological biases and tendencies. In conclusion, we all face daily risks, whether traveling to work, surfing a 60-foot wave, making investments, or running a business. Risk is the likelihood that an investment won't perform as well as you'd want or lose money. In the financial sector, the risk is the probability that an investment's actual return will differ from anticipated. Regular risk assessment and diversification are the most effective ways to control investing risk. Diversification can increase returns based on your goals and target degree of risk, even while it won't ensure gains or protect against losses. Investors and business managers can achieve their financial goals by making investments they are most comfortable with, by finding the correct balance between risk and return. Conclusion. The easiest way to get started is to start once you've decided on your financial goals and where you want to invest. To build up your confidence to invest more money over the long run, you might wish to test out your selected platform with a smaller sum first. There is no specific period when you should hold your investments when it comes to investing, but we advise keeping them for at least 5 years to even out the ups and downs. Your financial goals should determine the length of your investment. For instance, if you are 35 and want to retire at age 55, you must invest for at least 20 years. As with any investment, you should only invest if you are prepared to put your money down for a few years while being aware that there is a chance you could lose money or make money. You mustn't immediately spend any money you might need, like your emergency cash reserves. Introduction. One of the finest ways to make money is through real estate investing, a wise choice all year. Even yet, it can be difficult if you lack basic understanding and direction, especially if you are not familiar with the area where you intend to make investments. It is better than mutual funds, fixed deposits, shares, and bonds, but it might destroy your life savings if you don't understand the basic regulations controlling this sort of investment. The real estate sector is developing and enticing. Real estate has developed into a multi-trillion-dollar sector and is still a crucial aspect of daily life. In summary, whether at home, at work, during leisure time, etc., we all understand the importance of having a roof over our heads, and these roofs are constructed with certain materials and fulfill specific roles. Understanding the framework of the real estate market industry requires knowledge of the following concepts: economics, risk, and investment. Real estate investing has a fairly straightforward philosophy. The aim is to put money into investments and let it develop so that more money is available. All investments involve risks, but the potential benefit must outweigh the risk. Consider the game of Monopoly as an example. To succeed, one must buy homes, avoid declaring bankruptcy, and collect rent to pay for even more homes. If only everything were that simple. Although the idea is similar in real life, making a mistake during the investment process could have disastrous results. When you're ready to begin investing in real estate, you should choose a certain kind of real estate. This book provides information about the types of real estate investments that best meet your needs and goals. Whether you are a beginner investor or experienced, you will learn about all the steps involved in the investment process. Chapter 1. Understanding Real Estate Investing Basics. 60% of all assets globally are classified as mainstream. Real estate makes up a considerable amount of all national, corporate, and individual wealth. Given this, it is obvious that anyone searching for asset classes to allocate some of their cash to should give real estate investing some thought. But understanding the basics of real estate investing is necessary before you can decide whether or not to invest in real estate and which of the numerous forms of real estate would make the most sense for you. This chapter aims to provide you with a thorough introduction to real estate investing. It addresses the question, what is real estate, that even some seasoned real estate investors find difficult to answer properly. What is real estate? Real estate investing is the purchase, ownership, acquisition, and administration of land, properties, or anything else for financial gain. Real estate can be a beneficial addition to a portfolio of investments. Every piece of real estate is different, and they aren't creating any more of it. Whatever sort of real estate investing you choose, real estate is a terrific way to increase your return on investment. Whether you want to be a very hands-on investor or fully hands-off, a wide variety of options are available to real estate investors. Why real estate is a popular investment choice. Real estate is a very solid investment since a tangible asset backs it. An investment property will often hold its value and increase over time. It is improbable that you would suffer a total loss on a real estate investment if you pay your mortgage in full each month and have the appropriate insurance. Real estate can be a secure option to spend your hard-earned money on something constantly in demand because people will always need a place to live. Therefore, It shouldn't be surprising that real estate is a common investment nowadays. Let's examine some of the additional factors contributing to its popularity. Investors make a profit very quickly. Real estate investors can start seeing cash flow immediately, depending on the investment and how it was obtained, i.e., with or without financing. For instance, a turnkey real estate investment already has a desirable tenant and has been thoroughly refurbished. You get your first rent check at the end of the first month. Equity and long-term appreciation grow over time. Long-term real estate investments generate a monthly positive cash flow and increase equity. You use your tenant's rent to pay down every mortgage payment. You are ultimately having someone else pay for your investment when you pay off a mortgage with the money provided by your tenant. The second advantage of a long-term real estate investing approach is appreciation. In the majority of markets, property values increase with time. Zillow reports that real estate value in the US has climbed by 6.9% yearly. Therefore, the home you buy now for $150,000 could be worth $292,000 in 10 years. Low barrier to entry. Getting started as a real estate investor is not as hard as it sounds. To make your first investment, you don't need to have thousands of dollars on hand. Utilizing the several available financing options is the key to success for several real estate investors. You might only need to pay 20% down on the house to begin investing in real estate, and you can finance the other 80% with a low-interest mortgage. Other possibilities, such as non-recourse loans, hard money, or even personal loans, are available if you cannot obtain a mortgage. To maximize your real estate investments, you must know your financing alternatives. Investors have the option of using leverage. An investor usually needs $100,000 in cash to purchase $100,000 worth of stocks or mutual funds. However, a real estate investor can purchase a piece of property worth $100,000 for only $20,000 in cash and the rest $80,000 via a loan. Even though some properties, think fix and flip investors, might not qualify for a regular mortgage, many real estate investors can obtain several mortgages and expand their portfolios with as little as 20% down on each home. As we will explore in more detail later in this book, real estate investors use conventional financing to leverage their cash on hand so they may buy additional properties and optimize their investment chances. Real estate has a low barrier to entry and high growth and diversification potential for a portfolio. Investors can purchase properties practically everywhere using resources like reputable property management firms. Investors benefit from tax breaks. Tax breaks available to real estate investors are not available to other investors. A real estate investor may claim the following deductions: mortgage interest, depreciation, property taxes, insurance, repairs and upkeep, and travel expenses for business purposes. Other strategies exist to prevent a real estate investment from going under, such as using a 1031 exchange to reduce capital gains taxes. Deductions may result in a higher positive cash flow for the investor and a lower tax bill. The time commitment can be adjusted. Turnkey investors merely use real estate investments as extra passive income, whereas fix and flip investors and investors who serve as property managers make investing their full-time profession. Different time commitments are needed depending on your investing approach. Investors can manage risk. You've probably heard the saying, the higher the risk, the greater the reward. This proverb has stood the test of time and applies to real estate investing. Lower class assets can offer higher yields on paper, but they also carry a greater risk of loss. Although higher class assets typically have lower yields, they are considered safer investments. Investors can choose real estate investments based on their risk tolerance, much like in the stock market. Types of real estate investments. Real estate investments come in various forms, but the majority can be divided into two groups. Real estate investments that don't involve the ownership of physical property, such as REITs and crowdfunding platforms, include tangible assets like land, homes, and commercial buildings. Traditional, tangible real estate might yield a high return on investment, but it can also come with substantial upfront and recurring costs. Due to the reduced financial entry requirements of REITs and crowdfunding platforms, investing in a variety of real estate is far more affordable than buying even one traditional property. Another benefit of alternative real estate investments is the unique advantage of not having to leave your home or put on clothes to begin investing. Here are 5 different sorts of real estate investments to take into account. 1. REITs. Real Estate Investment Trusts, or REITs, own commercial real estate. Think of hotels, offices, and shopping centers. Shares of these businesses are available for purchase on a stock exchange. You can participate in these companies' real estate by purchasing a REIT without taking on many of the risks that come with direct real estate ownership. 2. Crowdfunding platforms. Crowdfunding platforms for real estate give investors access to real estate ventures that could yield huge profits but also come with many risks. Some crowdfunding platforms are only accessible to accredited investors, who are those who have a net worth of at least $1 million or a joint net worth with a spouse, excluding the value of their home, or an annual income of at least $200,000 over the previous 2 years, $300,000 with a spouse. 3. Residential property. Residential property includes single-family homes, condos, and vacation properties, almost any place people live or stay. Investors in residential real estate generate money by charging rent to tenants, or monthly payments for short-term rentals. 4. Commercial property. Commercial property is a location that a company rents or leases. Commercial real estate includes leased restaurants, gas stations, strip malls with multiple businesses, and office buildings rented by a single company. Each firm would pay the property owner rent unless it owned it outright. 5. Vacant land. Will they come if you build it? Investors often purchase the land for either commercial or residential construction. However, if you intend to develop the land yourself, buying it for development involves some market research. The person most suitable for this form of investment has a sizable amount of money to invest, in-depth knowledge of all things real estate, including building codes, zoning laws, floodplains, and knowledge of the regional residential and commercial rental markets. Risks of investing in real estate. When investing, the ability to recognize risk is essential. In this section, we'll discuss numerous areas with substantial investing risks. Capital risk. This implies the loss of capital. The downside of an investment is one factor to consider when assessing capital risks. How much money can an investor lose if things start to go wrong? The worst-case scenario can exceed the initial outlay. Capital risks can extend beyond the amount of the initial investment. Did the investor invest 80% of their net worth? If that's the case, there's a major risk involved that could potentially spell ruin. Risk of ruin is a notion in trade. It warns against trading more than X% of your capital to avoid blowing up your account. Real estate investors can use this idea to indicate that putting a sizable portion of net worth into an investment with above-average risk can result in sizable losses. Choosing an exit strategy falls under the capital risk category. Do they have a point at which it is viable to exit the investment if things go against them? Additionally, keeping tabs on spending is essential. What are some potential high-cost yet low-probability expenses? These costs often come under capital expenses, including a leaking roof or a malfunctioning HVAC system. Debt. Real estate investing often uses debt financing. However, the kind of debt financing is crucial. Do you have a non-recourse loan? The lender will then demand collateral seized in the event of failure. Another crucial step is to understand the terms of the debt arrangement. Certain debt covenants may have been included in the agreement by the lenders. If the borrower is unaware of these covenants, they may be violated, leading to unfavorable outcomes. Before applying for a loan, the borrower should have an understanding of what their debt coverage ratio will be. The debt coverage ratio reveals how much debt is repaid through rental income. For instance, a debt coverage ratio of 2.00 applies to a mortgage of $1,000 per month on a house renting for $2,000 per month. A loan covenant may contain a minimum debt coverage ratio that the lender may require the investor to meet. Liability. Ample insurance coverage is required for properties in case someone is injured there. But insurance doesn't always pay for everything. Contracts are crucial for addressing the majority of other issues. Costly legal battles may be avoided with the aid of an arbitrage provision. Additionally, keep in mind that you should budget money for insurance deductibles. Liquidity risk. Even meticulously planned undertakings occasionally don't go as expected. Delays and overruns happen often. An investor might need to discover new financial sources quickly. It's a question of liquidity. How quickly can an investor generate funds for unplanned or urgent costs? Arranging a new loan will probably take too much time. It's possible that investors won't invest extra money in a project. Investors can occasionally be the only source of financing. However, liquidity becomes an issue if the investor's whole investment has already been made in the project. This could imply that the investor is forced to sell a portion of her illiquid assets at fire sale rates to raise quick cash. The risk of ruin and the liquidity crisis are strongly intertwined. When liquid resources are depleted, and too much net worth is invested in a project, there is little to no tolerance for error. Market risk. National and local real estate market trends are tied to market risk. All real estate assets within the economy may be impacted if the economy is on the verge of a recession. On the other hand, while the economy can be performing well, local markets might be going through a slowdown. Strong research at the local and national levels can help with this. Consider how a neighborhood will appear in 10 years for a local area. What are the trends right now? Where are crime, market rents, and schools going? Do individuals take care of and upgrade their homes? Property diversification can lessen local market risk but has a limited impact on reducing national market risk. The more properties an owner owns in various areas, the less probable vacancies will impact their overall portfolio. Over-leveraging. Over-leveraging is the practice of borrowing money relative to the value of an investment. Debt is utilized when an investor lacks the capital to invest in a project or when a shareholder seeks to increase returns. Debatable and dependent on each situation, the debt amount is considered excessive. However, an investor becomes over-leveraged when they pile on debt to the point where any cash flow issue could prevent them from making loan payments or raising money to meet a loan-to-value covenant if the property loses value. The amount of debt taken upfront is not necessarily the determining factor in over-leveraging. Depending on the loan kind, it may change. For instance, a loan with an adjustable rate may see payments rise to a level the investor cannot afford. The callable loan may be called if the investor lacks the funds to repay the loan. The investor was over-leveraged in both situations. Investors who use financing should have properties that produce steady, reliable income that can meet the lending costs. Anything else could expose an investor to over-leveraging. An effective risk analysis technique involves ranking the different risks that might occur in a real estate investment. Investors can assess the greatest risk first, and if they find that it cannot be properly reduced, they may reject the project. This is substantially faster than going through a longer, unordered list of dangers. Chapter 2. Market Analysis for Real Estate. A real estate market analysis helps gather information to decide whether to invest in a property or assess the possibility of renting out a city or area. In reality, making such a large-scale purchase without having the necessary information would be insane. Market research is every investor's first step before entering the market. The goal is to confirm that the proposal is feasible and that the existing market accepts it. A thorough real estate market analysis requires patience, which not all real estate investors possess. You must study if you want your real estate business to stand out. So, what does real estate market research entail? What is real estate market analysis? Real estate market analysis, commonly called a comparative market analysis, examines the current market values of properties comparable to the home you want to buy or sell. You must always conduct a real estate market study, whether buying or selling a home. It will help you understand the current market, how much comparable homes are worth, whether it is an investment property, how much you can charge for rent, etc. Real estate brokers and agents produce reports to help sellers set list prices for their properties and, less often, to help buyers make competitive bids. Real estate market research data helps both the seller set a listing price and the buyer determine whether the price is fair. What are the reasons for doing a real estate market analysis? I'll explain why you should always conduct a real estate market analysis, whether purchasing or selling a property. If it's an investment property, This study will also show you how much you may charge for rent and how much houses identical to yours are worth in the current housing market. A real estate market analysis, often known as a CMA, provides data that both the seller and the buyer can use to determine whether the asking price is appropriate. To ensure that buyers and sellers receive a fair bargain based on the worth of the property, a CMA should always be performed. You can accurately determine a home's price by evaluating comparable properties currently on the market. Conducting a market analysis for real estate investments. When conducting real estate market research, you must use a systematic and planned strategy. You can divide your analysis into 4 categories: market, supply, demand, and environment. Next, you must formulate the appropriate questions. The clear goal is to evaluate the market potential and confirm the project's commercial viability. Step 1. Studying the market and its development. It's crucial to first gain a global understanding of the market. The goal is to increase knowledge in this area, including market size, trends, and likely development. Here is an illustration of a list of inquiries to make when researching the market and its expected development course. What is the market's size specifically regarding sales, customers, and turnover? How is the market currently doing? What are the chances for it in the upcoming years? A market may be expanding or staying the same. What are the tendencies in the industry today? Which goods and services are offered on the market? Who are your primary or secondary competitors? What do they provide? How do the products and services you offer and those of your competitors differ or are the same? What are your purchase terms and conditions? What terms and conditions can my potential suppliers provide me, and who are they? By answering these questions, you can improve your understanding of the market position and the players involved. Step 2. Studying the demand. The goals of studying demand are to know the market's consumers and determine whether profit is possible. When assessing demand in a real estate market survey, the following is an example of a list of questions to ask. How many consumers are there in this market? How is this number changing? Is it rising, falling, or staying the same? Who are these customers in real estate specifically? What location are they in? What is the client's rate of consumption? What do they do? What factors influence customer decision-making? What is the spending plan? What factors are crucial for prompting a purchase? Step 3. Analyzing the proposal. The analysis of the proposal entails carefully examining what products and services your competitors currently have to offer. Here is an example of a list of inquiries to think about the offer. Who are the market competitors? Who are the market leaders among the companies? How big are the main competitors? How do they choose their places, and where are they located? How long have they been in business, and how are their finances? What standards are used by certain competitors to succeed more than others? You can find opportunities to plan your future products and acquire competitive advantages by carefully examining your competitors' product lines. A real estate market analysis will give you a deeper grasp of what succeeds, what is necessary for success, and what has failed. Step 4. Studying the environment and the law. The environmental analysis study examines all potential market influencing elements, such as relevant regulations, technological advancements, and other potential influences. Here is an example of a list of questions to ask when researching the environment. What innovations are affecting the market? What is the legal system that controls the market? Are there any laws that are unique to this industry? What patterns can you observe in the development of legislation? Do professional organizations or other actors influence the market? Step 5. The gathering of data. One of the most crucial steps in performing real estate market analysis is data collection, which enables you to obtain details that will enable you to decide if you should buy a property. Start gathering the data you need to protect your investment in the real estate market by conducting real estate surveys. Step 6. Summarizing the outcomes. Investors will be able to conduct an analysis and choose the best techniques to secure the investment by being presented with a report containing the information they have gathered. Real-time data visualization offered by survey software enables you to pre-analyze the information and create a report highlighting the most important information so stakeholders can see it and make better decisions. Make the proper decisions with the help of data to start striking out in the real estate sector. using data to make informed property investment decisions. Besides being lucrative, the investment sector is also cutthroat, unforgiving, and volatile. You are unlikely to discover its advantages if you are not intelligent, dynamic, and analytical. Real estate is complicated, and numerous risks could have negative, far-reaching implications. Statistics have provided helpful insight into the criteria of what constitutes a successful real estate investment in an era where we have access to a vast amount of data. A significant percentage of the uncertainty in real estate investing is eliminated through property data analysis. To effectively anticipate a suburb's investment potential, it's crucial to consider various sets of statistics because data taken alone can be harmful and easily misread. What are those points then? It's crucial to recognize that understanding when to invest will tell you where to invest before we delve into the specifics of each data set. Location, location, location. This saying about real estate has been repeated repeatedly. However, most first-time investors will focus on the suburbs nearby where they currently reside, which is the incorrect approach. It is essential to adopt a national strategy to gain access to the greatest investment markets. Doing so will provide you access to chances in markets that are at more advantageous points in the property cycle, from the suburbs close to where you live to nationwide markets. Many macroeconomic parameters, such as population growth, infrastructure investment, employment growth, pay growth, future housing supply versus underlying demand, affordability, GDP for the LGA, etc., must be considered to pinpoint these suburbs. Looking more into the facts will help determine when to enter this industry. These factors will dependably show you where to invest. Consider the construction of a train line as an example. When should prices rise as a result? When a project is announced? When it is started? When it is finished? Or 2 years later, when the community is screaming about the decreased trip to work? So how can you choose the ideal moment to invest in a specific suburb? In its most basic form, the real estate market can be divided into 3 categories: buyer's market, seller's market, or equilibrium, as it oscillates between the two. A potential investor can still secure a position in the market by purchasing the transition from a buyer's to a seller's market, while also enjoying the price growth that follows as demand rises and the market becomes more favorable to sellers. This transition period won't last for more than 10 to 12 weeks. What kinds of data should one use to spot a market in transition? Days on the market. When analyzing 90-day rolling averages over the previous 4 periods, the pace of change for the suburb's days on market indicator stabilized and subsequently fell, quarter over quarter. The fact that houses sell more quickly after they are on the market shows higher buyer demand. A better understanding of the connection between vendor and market expectations would also be helpful. Simply put, demand exceeds supply. Vendor discounting. When 90-day rolling averages from the last 4 periods are analyzed, the average discounting metric rate of change for the suburb has stabilized and is starting to fall quarter on quarter. This suggests that sellers may be less flexible on their asking pricing with a healthy level of consumer demand. Volumes of sales. When comparing quarterly changes in the suburb's sales volume statistics over the previous 4 periods, 90-day rolling averages showed a constant upward trend. Listing volumes fall in a buyer's market because most sellers hold off on selling until the market is more favorable. When this trend changes, and the criteria, as mentioned earlier, also change favorably, it suggests that more sellers are putting their properties on the market to take advantage of the high level of buyer interest. Gross returns. The rate of change for the suburb's gross yield metric has risen when you compare the measure's 365-day rolling average to its 90-day rolling average. This typically indicates that tenants' interest in a location is growing. Generally speaking, they are prospective buyers, making this a leading indicator of demand from prospective buyers. Rates of vacancy. The vacancy rate in the area is lower than the median value of the long-term, last 5 years, trend line. This suggests a tight rental market, which is crucial for investors because the property must be easy to rent. A sign of this is when supply is insufficient to meet demand. A potential investor should provide a weighting to each score for each criterion. It's vital to consider the data mentioned earlier in context. Even if a suburb is poorer in one particular category, it may still be a wise investment spot. In the end, A sizable percentage of the risk associated with investing in real estate can be eliminated by effectively using the data currently at our disposal. It's likely to find markets at the right cycle point by analyzing significant datasets and statistics, showing an investor where to invest. The leading indicator of location is timing. Buying and holding is still the most secure and effective investing strategy, whereby timing the market is less important than time in the market. Chapter 3: Building a Portfolio of Investment Properties. Would you want to know how you can create a portfolio of properties? Given the abundance of available possibilities, entering this industry is not easy. But because of our unique position in the real estate investment sector and ongoing market analysis, we can navigate investments and build profitable portfolios. Knowing the ins and outs of establishing a property portfolio successfully is crucial if you're looking to do so. This chapter reviews all the information you need to succeed as a portfolio landlord. What does property portfolio mean? An investment property portfolio is a group of assets owned by a person, a group, or a business and used to produce passive income over the long term. This can include real estate rented out to tenants on a long or short-term basis in the residential, commercial, and industrial sectors. The primary goal of investing in a portfolio of buy-to-let properties is to produce passive income for the investor. This can be accomplished by keeping the properties for an extended period, allowing them to increase in value over time, and eventually selling them for a profit. The investor may decide to rent out the properties as an additional means of profiting from their investments. A properly managed investment property portfolio ought to generate consistent income and contribute to wealth accumulation. Even though one investment property can produce a consistent, predictable income, having multiple properties, especially diverse ones, might offer a good cash flow, possibly enabling you to retire early. Developing a real estate investment strategy. Owning a property is an excellent strategy to diversify an investment portfolio with a holding that produces returns equal to those of the stock market but with less volatility. Additionally, residential real estate offers investors special tax advantages, and investors can employ leverage to increase overall returns. There are numerous ways for investors to profit from real estate, even though directly owning investment properties is the most popular. Here are 10 real estate investing strategies experienced and novice investors use. 1. Buy and hold rental property. Buying and holding properties is a real estate investment strategy used to generate rental income, profit from long-term property value growth, and take advantage of special tax benefits available to real estate investors. Over the past 20 years, the median sales price of properties sold in the U.S. has climbed by almost 200%, and the demand for rental housing is still high. Even yet, the net income from rental properties may vary due to upkeep, repairs, or prospective vacancies, and some investors might want a more passive approach to investing. 2. Reinvest rental income. Many buy and hold real estate investors adopt the complementary approach of reinvesting rental revenue. Net cash flow from one rental property is preserved until there is enough money for the down payment on a second rental property, a strategy often known as the snowball effect. Then, until there is enough money for a third rental property, the net cash flow from both properties is saved. The amount of money generated grows as an investor's portfolio of rental properties expands. To pay off a mortgage on a piece of property more quickly, some owners also reinvest rental revenue by making extra mortgage payments. The investor performs a cash-out refinance to convert accumulated equity into cash to buy another rental property once sufficient equity is from combined appreciation and mortgage prepayments. 3. House hacking. One disadvantage of investing in rental property is the potential need for a sizable down payment. A real estate investing strategy called house hacking is utilized by homeowners who don't yet have enough cash to buy a rental home. Rental of a spare bedroom or converting a basement into a studio apartment are two instances of house hacking. Savings from house hacking rentals are used as down payments on rental properties till funds are available. Some investors will also employ a low down payment Federal Housing Administration (FHA) or Veterans Affairs (VA) loan to buy a small, multifamily property. The requirement that the borrower resides in one of the units as their principal residence is one of the potential disadvantages of this strategy. However, residing next to tenants is a great opportunity to learn about real estate investing and obtain practical property management expertise. 4. BRRRR. BRRRR means buy, rehab, rent, refinance, repeat. Real estate investors utilize the BRRRR method to buy fixer-upper properties utilizing short-term financing, perform necessary repairs, rent the properties to qualified tenants, and then refinance and withdraw cash after the properties have a stable history of positive cash flow. The BRRRR real estate investing approach is comparable to the snowball impact in that an investor repeats the same action. BRRRR is typically a more advantageous option for an active investor with the time and expertise to complete tasks or who has a reliable, cost-efficient network of handymen and contractors to assist with renovating. Short-term financing often entails high loan fees and interest rates, so an investor should be careful not to run out of cash until the property starts to cash flow. This is one disadvantage of BRRRR. 5. Fix and flip. If everything goes according to plan, house flipping is a high-risk real estate investing technique with a potentially high payout. Since they only intend to hold a property briefly, investors who fix and flip properties do not want to be landlords. A flipper may hold on to an undervalued property and hope to profit from appreciation after finding and buying it. Alternatively, they may undertake strategic improvements to boost the property's value. Investors who cannot flip a home quickly or underestimate the cost of renovations may run out of money. Fixing and flipping is best suited for those with substantial experience in determining the fair market value of a house, the actual cost of renovations, and enough funds to complete the project on schedule and under budget. 6. Real estate wholesaling. Real estate wholesaling is a version of fixing and flipping, an investment technique in which the wholesaler never takes over the property. As an alternative, a real estate wholesaler looks for a distressed property with an inspired seller, contracts the house at a discount, determines the cost of repairs and the property's final fair market value, and then assigns the purchase and sale agreement to another investor in return for a small wholesale fee. For real estate wholesaling to be effective, it takes a lot of effort, market expertise, and strong negotiating skills to persuade an owner to sell their home for less than the fair market value. In many states, a property wholesaler must also have a license. Real estate wholesaling could be a good investment plan for those with limited investment capital. Some seasoned real estate wholesalers employ real estate bird dogs to find a distressed property, and when the property is located, they give the bird dog a small referral fee. 7. REIGs. Small funds called real estate investment groups, REIGs, buy groupings of rental properties and then let investors purchase those properties from the group. The REIG manages the marketing of vacant properties, tenant screening, rent collection, property management, and maintenance in return for a portion of the monthly rental income. When the properties in the group are sold, investors in an REIG profit from their shares of any equity growth and recurring rental income. People searching for a hands-off real estate investing strategy can find an REIG a viable alternative. Still, it's important to examine management and their prior record of success or failure. 8. REITs. Real estate investment trusts, REITs, invest in various real estate assets, including commercial real estate, residential build-to-rent (BTR) subdivisions, or special use properties like data centers and cold storage facilities, which can be publicly or privately held businesses. At least 90% of REIT's profits must be distributed as dividends to shareholders. They can be a useful strategy to diversify a portfolio of investments to make money from real estate without owning any real estate. Long-term leases with credit tenants are usual for investment-grade assets owned by a REIT. Publicly listed REITs are more liquid than other real estate investments because their shares can be purchased or sold on an exchange. REITs, however, don't offer some of the benefits of directly owning a rental property, such as having direct control over decisions regarding property management. 9. Crowdfunding. Online real estate investment platforms called crowdfunds allow investors to pool their cash to purchase shares of premium commercial and residential properties like newly constructed homes, apartment complexes, and commercial real estate that have been stabilized. Crowdfunding can be a great method to get exposure to properties that are out of reach for most investors. If a project is lucrative, crowdfund investors will get regular pro rata distributions of net income along with a portion of any profits. Shares often have lockup periods until a project is stable or during economic instability, which is one of the disadvantages of crowdfunding. To find profitable prospects, finance and build the project, and lease and manage the property to increase asset value and cash flow, investors must also rely on the experience of the crowdfund sponsor. 10. Private lending. Private lenders finance real estate loans instead of investing in stock. Private lenders give money to real estate investors looking for an alternative to conventional financing sources, such as home flippers, instead of buying rental property. Like a typical bank, private lenders generate income through lending fees and interest rates. But generally speaking, costs and interest rates are higher. Even though private lending might be a wonderful strategy to earn consistent interest revenue, there is a chance that a borrower would default, and the lender will have to take back a partially refurbished home. Because of this, private lenders have real estate investing knowledge and know how to safeguard themselves if a property needs to be foreclosed. 8 steps to build a property portfolio. Even if you are familiar with real estate investing, managing tenants, diversifying your holdings, and growing a portfolio may overwhelm you. Real estate portfolios are a long-term investment strategy that can generate consistent income when used properly. Here are our top recommendations for beginning, expanding, and maintaining a real estate portfolio. 1. Market research and advice seeking. Knowing the kind of properties available, which areas are in demand, and how much you'll need to invest is one of the first stages to developing a solid portfolio. Prioritize your study before investing to ensure you thoroughly understand the costs and value they will add to your portfolio. When you are planning, you should do research in the following areas. The available property strategies. It's crucial to realize that many variables affect which path to take as you evaluate the property as an investment option. What you choose to invest in will be influenced by your financial status, goals, time horizon for your investments, and preferences. First, decide whether to invest in commercial or residential property. Then do additional research on HMOs, build to rent, social housing, and student housing in the buy-to-let industry. Find out which strategy would reduce risk and guarantee the best return on investment over time. Tenant type and rental demand. Before promoting a rental property, consider rental demand and the sort of tenants. Do you want tenants who plan to move out after a few months, or do you want them to stay for the long term? Is the location of your business in a hip neighborhood that draws young professionals, or is it in a more residential region that welcomes families? Once you've determined the kind of tenant you want, it's essential to consider the local facilities and transportation options. The likelihood of void periods decreases as the area becomes more populated. Purchase price and ongoing expenses. Before investing in a buy-to-let property, ensure your finance options will cover all expenses associated with maintaining, repairing, and remodeling the property, including the purchase price and ongoing expenses. Additionally, fees like stamp duty, insurance, taxes, property management firms, estate agents, and more must be considered. Your affordability will be easier if you consult a financial counselor. Rental yield hotspots. To ascertain possible rental income, a landlord must examine the average rental yield in the chosen city. The annual rental income from a property is calculated as the annual rental income divided by the annual property value. With the help of this information, you can decide what kind of real estate would be advantageous for you to buy and rent out. You should also look into the neighborhood's average house and rental costs to ensure solid returns and a high chance of capital growth. 2. Establish long-term goals and plans. Before deciding to purchase your first rental property, considering your long-term objectives is good. Do you prefer to profit from capital growth when you sell the home instead of monthly returns from rental income? You might need to keep your property for a very long time, renting it out during that time, to see its value rise. The time you must devote to your real estate firm must also be considered. If there is a vacancy, decide if you want to be a hands-on landlord that addresses maintenance concerns, looks for renters, and collects the rent. A lettings and management agent can also take care of it for you. you can concentrate on your current job, business, or retirement goals. Don't forget to consider your legal responsibilities as a landlord and any potential buy-to-let taxes. 3. Build your portfolio gradually by starting small. When starting your path into real estate investing, nothing is more crucial than making a sensible choice for your first property. Acquiring several properties at once can be tempting when buying your first home to maximize your return. But starting cautiously and with much thinking is important to build a sizable portfolio over the long run. For new investors, a low-risk option is best. You'll have a better chance of succeeding as a landlord and expanding your portfolio rapidly if you choose a property that needs little upkeep or repair. 4. Consider a limited firm. When you own multiple properties, you can discover that becoming a limited company is better for tax payments. Company taxes are lower than individual taxes due to higher income tax rates. This implies that by setting up a limited company, you may keep your profits inside the business and use them to pay for future purchases without paying income tax. Because they receive more tax liability protection, many landlords elect to register their properties as limited companies. If you sell one of your buy-to-lets, you won't generate a capital gain if you retain profits within the company, avoiding capital gains tax. 5. Buy off-plan housing. For several reasons, investing in buy-to-let real estate off-plan is worthwhile. First, once construction is finished, the property's worth from the planning stage will probably increase. You can take advantage of this boost in value if you purchase right away rather than waiting until construction is complete. Second, purchasing property before development is complete allows you to bargain with the developer for a better value. You might get discounts on investments or more enticing terms as a result. Lastly, purchasing off-plan real estate enables you to lock in your investment before anybody else, decreasing the likelihood that another party will acquire it before development starts. 6. Employ a property manager. The management of your rental properties can get onerous as more obligations pile up while you seek to expand your real estate empire. The requirement to hire third-party property management increases as your portfolio expands. This helps ensure that all responsibilities under the law are fulfilled and that all tenants and properties receive the required degree of care. One of the duties of a property manager may be to organize and supervise maintenance and work orders, hire contractors to complete maintenance work and repairs, handle tenant complaints, effectively market vacant properties, arrange viewings and paperwork for new tenants, and collect rents into your account. Property managers often get between 8 and 12% of your rental income. While employing assistants may lower your overall returns, it may also allow you more time, the opportunity to purchase more properties, and time freedom. 7. Scale back your real estate investment holdings. Once you've acquired control of your first property, begun to generate a reliable income, and established yourself as a pro in the real estate investment business, it's time to expand your stock of real estate holdings. You can buy land, convert buildings, multi-unit buildings, off-plan homes, or completely new construction. You should consult your investment counselor and accountant to choose the appropriate second home. You can grow quickly with the help of financial solutions. Joint ventures and partnerships are a dependable and efficient way to access another person's contacts, resources, and expertise, enhancing your real estate firm and your potential to scale. Additionally, requesting property financing may enable you to find your desired investment properties. 8. Have a backup plan, an exit strategy. Investing in real estate without a plan for exiting the investment can be risky since it increases the likelihood that you won't see significant returns or get back as much as you put in. An exit strategy is implemented to lessen the likelihood of failure and to limit risks. It gives investors a specific aim or target to strive for, directing their investment timetable and financial projections. Some of the most popular escape tactics are listed below. Time-based approach. This exit strategy involves selling a single property or several properties after a predetermined number of years. This is advantageous for individuals intending to sell as they get closer to retirement. Still, investors should consider potential tax obligations arising from the sale. This will change the total profit from capital appreciation. Value-based approach. Investors may decide on a target they want to achieve in terms of value rather than time. Once a property reaches a certain value, it is sold to make room for other, more expensive investments. To plan for value rises or losses, this technique necessitates routinely monitoring tenant demands, market movements, and property predictions. Yield-based exit strategy. When you intend to sell a property when the average yield falls and no longer delivers enough returns, you employ a yield-based exit strategy. This technique can be used on any property. However, multi-unit residential and commercial properties perform best. The time to sell arises when yields fall under a specific cutoff point. Chapter 4. Real Estate Investment Trusts, REITs. Any equities or fixed income portfolio should consider real estate investment trusts, REITs. They can offer greater diversification, higher possible returns, and less overall risk. In brief, they are a great counterpoint to stocks, bonds, and cash since they can produce dividend income and capital growth. Real estate investment trusts are involved in REIT investing. Commercial assets that generate income are owned and managed by REITs, whether the actual properties or the mortgages securing them. You have three options for investing in REITs: through the firms, exchange-traded funds, or mutual funds. There are numerous varieties of REITs. Here, we examine some major REIT categories and how to invest in them. By the end of this chapter, you should know more about REIT investing in general, as well as when and what to buy. What is a REIT, Real Estate Investment Trust? If you're not sure what REIT investing is, it's a collective investment plan that enables investors to buy shares in a portfolio of real estate assets that generate income. In case you were wondering, REIT stands for Real Estate Investment Trust. Real Estate Investment Trust is a business that manages, owns, or funds any income-producing real estate. Co-working spaces in the gig economy age illustrate this, where, like mutual funds, REITs pool multiple investors' capital. This shares the investments and dividends without needing individual management, as opposed to direct investment in real estate, such as purchasing a commercial property. REIT enables investors to have substantial exposure to real estate assets. How do REITs work? Depending on the REIT's classification, investors can select from a wide range of real estate funds, including equity REITs and mortgage REITs. Equity REITs own properties like hotels, stores, offices, condos, and other real estate types, whereas mortgage REITs get their money from mortgage-backed securities or interest on the assets. In essence, REITs rely on infrastructure development, structured governance, and encourage domestic and international investment to help smooth and speedy liquidation of your real estate investments. How to invest in different types of REITs. Investors have many possibilities when choosing a REIT for their investment portfolio. Before investing, it is essential to understand the many types of REITs that are accessible and their features. Investors can invest in three primary types of REITs in addition to the three classifications of REITs. Each type serves a different purpose and could offer various advantages. The various kinds of REITs include: 1. Mortgage REIT, MREIT. One of two approaches is used by a mortgage REIT, or MREIT, to finance real estate assets. Mortgages and other types of real estate loans are one way that some MREITs provide direct financing. Others buy or create mortgage-backed securities, MBSs, asset-backed securities made from collections of mortgages. Banks offer loans packaged as MBSs to MREITs or other investors. MREITs can obtain their mortgages or securities through various funding sources, such as repurchase agreements and structured financing. In neither of these agreements, the MREIT owns no actual real estate assets. Instead, the interest on its investments provides the income. Mortgage-backed REITs, MREITs, lend to other people to help them buy, build, and own commercial real estate that generates revenue. Investors receive a proportionate share of the MREIT's profits after its operating costs and finance charges have been met. Residential mortgages, commercial mortgages, Residential mortgage-backed securities, RMBSs, and commercial mortgage-backed securities, CMBSs, are just a few of the real estate assets that MREITs can invest in. Although some MREITs also engage in RMBSs and CMBSs, most participate in residential or commercial mortgage offers. MREITs generate income while assisting the real estate industry by charging interest on the money they lend to borrowers financing their acquisition of residential or commercial real estate properties. Mortgages created by REITs may be sold to banks, investors, or the government. Investing in a mortgage REIT, a guide. Investors thinking about MREITs need to be aware of several variables that could impact their investment. Interest rate risk. The net interest margin of an MREIT, which is the difference between the revenue from interest on its mortgage assets and its funding expenses, can be impacted by changes in interest rates. If MREITs retain fixed-rate mortgages among their holdings, rising interest rates can significantly reduce the value of those securities. To control their interest rate and credit risks, several MREITs use hedging strategies, including interest rate swaps, caps, or floors. Thanks to these strategies, investments in MREITs can be less risky. Volatility. MREITs may be more volatile than other REIT forms regarding price swings. Variations may influence this volatility in the net interest margin of the MREIT. However, when the spread is wide, MREITs may have a significant yield potential. MREITs can be privately held, publicly traded, or publicly non-listed. Shares of MREITs may also be purchased by investors via a mutual fund or exchange-traded fund, ETF. Here is how each of these channels might allow investors to purchase shares of MREITs. Stock exchange. Publicly listed MREITs are available to real estate investors on the main U.S. stock exchanges. Since they are SEC-registered REITs, they must publish financial statements regularly so that investors can evaluate their yields and general performance. A financial advisor or broker. Investors interested in purchasing publicly traded, non-listed MREITs may do so through a broker or financial advisor participating in the REIT's offering. A few brokers provide accredited investors with private MREITs. ETF or mutual funds. Investors can purchase MREIT shares through a mutual or exchange-traded fund, ETF. 2. Equity REIT, EREIT. An equity REIT, also known as an EREIT, makes investments in real estate and makes money by collecting rent from tenants. Commercial or residential real estate is an investment option for EREITs. During their business operations, EREITs carry out several tasks, such as maintaining, improving, and managing their real estate holdings. Property managers who work for EREITs often manage these physical assets for investors. As a result of this structure, EREITs are passive investments that have the potential to produce large returns through rental revenue. EREITs use rent payments to cover running costs for their properties and the payments of their property managers. The EREIT's net income is subsequently distributed to investors as dividends. Like MREITs, EREITs must distribute at least 90% of their net income to investors. The selling of properties is another source of revenue for EREITs. Capital gain distributions are how the EREIT pays revenue to investors when it can sell a property for a profit. Depending on the investor's income category, the IRS levies capital gains taxes at 0%, 15%, or 20%, lower rates than those of ordinary income. Many prospective real estate investors would picture EREITs when considering a REIT. These REITs contribute to funding initiatives that foster job growth, enable necessary services, develop infrastructure, and support economic growth. These REITs can be a good fit for a long-term investment strategy, such as one centered on retirement savings because they rely on rental payments for income. Warehouses, shopping centers, office buildings, hotels and resorts, senior living facilities, self-storage facilities, manufacturing facilities, and apartment complexes are just a few of the real estate assets that EREITs invest in. Investment Guidelines for Equity REITs. Real estate investors who are considering EREITs can find it useful to take into account a few characteristics specific to this kind of REIT that could influence their investment approach. Constant operational expenses. The EREIT's revenue may be impacted by the expenses related to leasing and managing residential and commercial properties. Possibility of real estate appreciation. These properties might also experience long-term growth due to real estate appreciation. Even while market swings impact property value, investors may see a consistent increase in the value of an EREIT's properties over time. But for EREITs to profit from appreciation, a property must be sold. Investors have little control over the process of real estate appreciation on the properties because the EREIT manager is in charge. Potential for huge income. Rental income from EREITs can be very lucrative, depending on the market and the chosen investment strategy. Potentially less volatile than MREITs. EREITs are more common than MREITs because they deal with actual real estate instead of mortgages and may be less impacted by market and economic situations. Due to their very low correlation with other assets like stocks and bonds, EREITs can also help investors diversify their portfolios. EREITs might be private REITs, PNLRs, or publicly traded REITs. Some EREITs are specialized and concentrate only on assets from particular industries, such as self-storage facilities or the healthcare industry, while others are more diversified. Some EREITs concentrate on particular investment strategies. One strategy would involve purchasing real estate buildings, for instance, that require construction or renovation before they can be rented to renters. Another strategy might be allowing only an EREIT to purchase fully occupied, income-producing buildings. Depending on the EREIT type they pick, investors may invest in an EREIT in the following ways. Stock exchange. Just like when buying shares of a publicly traded company's stock, investors can purchase shares in a publicly traded EREIT through a national securities exchange. The financial reports that these EREITs file with the SEC allow investors to examine the performance of these entities. Financial advisor or broker. If investors want to purchase public, non-listed, or private EREITs, they must do so through a broker or financial advisor. ETF or mutual funds. Investors can also buy shares of EREITs listed on the stock exchange through a mutual fund or ETF devoted to EREITs. 3. Hybrid REIT. EREITs and MREITs are combined to form hybrid REITs. Hybrid REITs employ the investment strategy of purchasing both real estate and mortgages. While they still buy both types, hybrid REITs often invest more heavily in one type of investment than the other. These REITs have more latitude to adjust their portfolio allocation in response to shifting interest rates, market conditions, and property values. By using hybrid REITs, investors can gain from holding EREITs or MREITs while reducing total investment risk. For instance, rising interest rates and falling property values are the main risks related to EREITs. Falling interest rates may also have a detrimental effect on the revenue MREITs get. Investors may be able to avoid some of the risks associated with each form of investment by making investments in hybrid REITs, where the REIT management actively manages the portfolio's diversity in response to these changing conditions. A hybrid REIT is required to cover finance costs for its investments in mortgages and MBSs and operating costs for its rental properties. Hybrid REITs must also pay out at least 90% of their net income as dividends to investors, just like MREITs and EREITs are required. Depending on the REIT manager's strategy, these REITs may invest in a mix of the following assets: manufacturing buildings, self-storage facilities, senior living facilities, apartment buildings, healthcare facilities, office buildings, shopping malls, residential or commercial mortgages, residential or commercial MBSs, senior living facilities, and self-storage facilities. Investing in a hybrid REIT, a guide. Investors may participate in hybrid REITs if they are unclear about the real estate assets they want to invest in, or want the REIT manager to manage the REIT's portfolio as market conditions change actively. Hybrid REIT's ability to engage in real estate assets and mortgages may appeal to some investors. The individual investor's investment goals and approach ultimately determine whether to invest in a hybrid REIT. The possibility of sector-specific investing is crucial for investors to consider when determining whether to invest in a hybrid REIT. In particular real estate market segments, such as residential or commercial assets, hybrid REITs can make investments. A hybrid REIT, for instance, might decide to invest in residential real estate, residential MBSs, and residential mortgages. Investors can select the hybrid REIT that best meets their needs. A hybrid REIT investment is comparable to an EREIT or MREIT investment. Stock exchange. A national securities exchange is where prospective investors can find shares of publicly traded hybrid REITs. Financial advisor or broker. Brokers or financial advisors are used to sell publicly traded, non-listed hybrid REITs. Through this route, accredited investors can also purchase shares of hybrid REITs. Chapter 5. Rental Property Management. One of the most significant choices an investor has to make when a rental property acquisition is completed is how to manage the property. While some landlords elect to outsource property management fully, others may do it themselves, DIY. Even though it might seem intimidating, it is possible to manage a home alone. This chapter examines a do-it-yourself landlord's primary duties and the 6 steps to managing a rental property. Management options for rental properties. Investors in real estate are never without options, and managing a rental property is no exception. There are 3 methods of property management that landlords might use. Managing a property yourself. Self-management of a rental property is often chosen by landlords with more time on their hands. For owners who struggle with delegation, doing their property management can be a viable solution. However, managing tenants can become stressful, and breaking fair housing and landlord-tenant regulations might result in a lawsuit against the landlord. Pay for management services. Some property management firms allow landlords to select services they want to contract. To help a do-it-yourself landlord market and show a vacant property, screen a potential renter, and sign a lease, several managers, for instance, offer a leasing-only plan. Pay-as-you-go property management may be effective for some landlords, but if the owner has a full-time job or lives in another state, it may be challenging to manage a rental property. Employ a property manager full-time. Choosing not to do it yourself is the third choice. Hiring a competent local property manager to handle day-to-day concerns, including tenant contact, maintenance and repairs, and legal difficulties, may be worth the monthly charge. Typically, a property management company will charge a monthly fee of 8% of the monthly rent. Many landlords consider that a negligible cost to pay to avoid the hassles of self-managing a property. Responsibilities of a DIY landlord. Some landlords are capable and manage their rental property. Here are the 3 broad areas of duty that DIY landlords should be aware of before deciding to do it alone. Tenant management. Tenant management demands a high level of interpersonal skills. Naturally, tenants want to believe that their money is being well spent. Landlords should be able to manage tenant concerns politely while setting limits on unreasonable requests, such as paying the rent after the due date without incurring a late fee. Keeping tenant turnover low and maintaining a healthy cash flow occasionally feels like a delicate balancing act. 3 legal facets of managing renters include understanding how much notice is necessary before accessing the property, being aware of state landlord-tenant legislation, and abiding by the Fair Housing Act. A violation of the law could result in hefty fines or perhaps legal action from the renter. Property management. For the benefit of both the renter and the area, landlords must keep the property safe and livable. An effective strategy to find minor problems before they become significant, expensive repairs is to do proactive property inspections. For instance, Seasonal maintenance of the heating and cooling system and gutter cleaning before the start of the rainy and snowy seasons may help to prevent costly repairs totaling thousands of dollars. Another duty of self-managing a rental property is to complete a move-in and move-out checklist with the tenant. It is easier to distinguish between regular wear and tear and abnormal damage if the house's condition is documented before the renter moves in and at the end of the rental agreement. Many states permit a landlord to keep back a portion of the tenant's security deposit to cover any damage the renter may have done. Financial management. Real estate investors buy rental property to make money, ideally every month. Managing the money by keeping track of every dollar earned and spent is one of a DIY landlord's responsibilities. The appropriate line item on the chart of accounts must be credited with rent payments, late fees, and security deposits. The same holds for the landlord's payment of utilities, property taxes, insurance, repairs and maintenance, and other running costs. How to manage rental properties. Let's now examine how landlords might effectively manage their rental properties. Here are 6 steps to self-manage a rental after buying a house and making it rent-ready. 1. Identify the reasonable market rental rate. It may appear to be an art and a science to determine the ideal rent. A rent price that is too high will deter potential tenants, while a rent price below the market can lower earnings. The area's median household and per capita income, prospective tenants' demographics, such as whether they are singles or families, the median rent being charged by the competition, and property features that would justify a higher rent, like a big garage or a neighborhood pool, are all things to take into account when setting the rent. To get rent comparisons for a home, use one of the many web services available. By establishing a fair asking rate based on recent listings, rent comparables, and market trends, they can spot possibilities to boost cash flow. 2. Market the vacant house. Many investors and property managers use online rental listing and tenant screening services created specifically for do-it-yourself landlords to discover appropriate tenants. With the help of websites like Avail and Rent Tech Direct, landlords can create a rental listing, automatically syndicate listings to the top online rental listing services, receive leads from potential tenants directly, offer online tenant applications and screening services, request credit, criminal background, and evictions reports while charging the applicant for the service, and create and sign a tailored lease for the state where the rental property is located. After choosing a tenant and signing a lease, the next phase is to collect the security deposit and first month's rent and meet the tenant at the rental property to finish a move-in checklist. 3. Inspect and maintain the property. The landlord's duties begin once the renter moves in. There will be maintenance and repair issues, and the sooner they are resolved, the happier the renter will be and the more likely they are to renew the lease. It can be a good idea to drive by the property sometimes without disturbing the tenant to check for exterior damage. It is beneficial to regularly inspect the inside and outside of the rental property after providing the renter the required notice to identify little problems before they become significant and expensive. Lastly, completing yearly maintenance on the roof, heating and cooling system, water heater, and appliances can help keep capital expenses under budget and extend their useful life. Many do-it-yourself landlords create a list of things a landlord or low-cost handyman can fix. Create a list of insured and licensed contractors to service the plumbing, electrical, and HVAC systems. Ask nearby fellow landlords for recommendations of dependable vendors, and regularly contribute to an emergency fund or CapEx, capital expense, account to prevent having to go into debt. These steps help streamline repairs and enable landlords to respond to maintenance requests from tenants more quickly. 4. Collect the rent and uphold the terms of the agreement. Investors buy rental property to earn money, and making money starts with timely and full rent collection. Many DIY landlords use online rent payment platforms like Tenant Cloud and Cozy for same-day rent collection with any processing fees paid by the renter rather than waiting for the check to arrive in the mail. Increasing rent collections is an excellent motivation for landlords to accept payments online. Most tenants prefer to pay their rent online and are more likely to do so. Do-it-yourself landlords should be ready to impose any late fees specified in the lease if a renter fails to pay on time. It's likely that if a tenant develops the practice of paying late without incurring a fee, they will continue to do so. Due to the landlord's cash flow issues, a landlord may have to evict a tenant who routinely pays late. 5. Evict rent defaulting tenants. Even with the best tenant screening procedure in place, evictions are occasionally necessary for landlords. Depending on the situation, the property is located in the city and state. A residential eviction may cost $3,500 or more and can take 4 weeks or more to complete. A landlord may have to repair significant damage caused by the tenant after they vacate since no rental income is coming in. Some landlords take a practical approach and pay a renter cash in exchange for returning the keys and leaving the property rather than throwing good money after bad. Though it may seem illogical, cash for keys is used to avoid an expensive eviction and immediately restore the rental property's income flow. 6. Utilize a reliable accounting system. The ideal accounting system will create accurate financial reports, including an income statement and a net cash flow report, and a system for keeping track of receipts and other paperwork for a paper trail. Chapter 6. Flipping properties for profit. Flipping is buying an asset to quickly sell it for a profit, rather than keep it for long-term appreciation. Flipping is often used to describe some investors' actions in initial public offerings, IPO, and short-term real estate transactions. Flipping can usually refer to purchasing an asset intended to be sold for a profit, including vehicles, cryptocurrency, concert tickets, and other items, even though these are the most common use cases in the finance industry. How flipping works. Real estate is where flipping is most often used to describe buying properties and swiftly, usually less than a year, selling them for a profit. Flipping typically refers to one of two forms in real estate. Real estate investors who seek properties in quickly appreciating markets and resell them with little to no extra investment in the physical property fall under the first category. Instead of the property itself, this is a play on the current market conditions. The second category is a quick repair flip, or reno flip, when a real estate investor uses his understanding of what buyers desire to raise the value of undervalued properties by renovations and cosmetic adjustments. Finding properties to flip. If you're keen to begin this project independently, your first concern is presumably, how do I discover a property to flip? This section discusses several factors to consider when looking for your first flippable home, including what to look for and try to avoid. Flipping homes is one of the more well-liked strategies to generate income flow in real estate investing. Finding a house to flip might be difficult, even though it can be profitable. Here are a few of the finest ways to locate a house to flip. Make use of a real estate agent. First, finding a real estate agent that understands your industry is crucial. Ideally, this person will be knowledgeable about real estate investing strategies, especially house flipping. The Multiple Listing Service, MLS, which provides you with a list of affordable properties like foreclosures and short sales, is accessible to real estate agents. Recognize your target market. One of your first steps must be to identify your target market to locate possible houses to flip. The goals are to find a fantastic deal on a house that needs work, do the work, and then sell the house for at or over market value. These communities are often developing regions with amenities, including public transportation, entertainment venues, shopping areas, dining options, affordable housing, and top-notch educational institutions. Examine nearby auctions. When a lender forecloses, the property is typically sold at auction. You can access online public information about these auctions. The date and hour of the auction should be mentioned in the listing. It's one of the easiest methods to find a house to flip at a decent price, but you'll need cash to buy the property at the auction. If you use this strategy, remember that you might not have enough time to inspect the house before placing a bid. Consider coming early if the auction allows prospective buyers to tour the house first. Before the auction, you can also drive by the property and make a visual assessment. Look for foreclosures. A house becomes a real estate-owned REO property if it doesn't sell to a bidder at auction. This means that the lender regains possession of the property. Remember that considerable cleaning and repairs may be required for the house. Check short sales. The lender may consider a short sale if a homeowner needs or wants to sell a home that isn't worth what is owed. This indicates that the house is sold to a buyer for less than the outstanding mortgage. Even though the house might require significant repairs, these homes can be a good investment for real estate investors. For instance, if a homeowner lacks the financial means to purchase a home, they will also be unable to afford the essential upkeep. Short sales are accessible on the MLS. Other choices. Try to drive through desirable neighborhoods while looking for properties that appear vacant or need repair. Find the owner using public records, then write to them to express your interest in the property. Some homeowners are eager to sell but are unaware of the potential value of their homes to investors. Renovating properties for maximum profit. Here are some recommended practices to increase the value of your real estate investment, whether you're fix and flipping the home or using a buy and hold approach to generate passive income. Concentrate on rooms with high value. Focus on remodeling lovely kitchens and bathrooms instead of finishing basements or expanding closet spaces and attics, since people spend most of their time here. If rewiring is necessary during a normal full kitchen makeover, which includes cabinet replacement, there may be delays and higher costs. To get around this, you may reface the cabinets with new doors and update the appliances, hardware, countertops, and backsplash, costing you less than half as much as buying and installing new cabinets. Reconsider hardwood floors. Even though many individuals choose hardwood flooring over carpet, the extra cost of labor and raw materials may push your flooring budget beyond $20,000, making it an unaffordable choice for many investors. The price of brand new hardwood flooring can range from $3 to $8 per square foot, depending on the size of the house. Modern vinyl flooring can be installed any place in the house, including the kitchen, bathrooms, living room, and more, if the property's current flooring cannot be salvaged. Due to its ease of cleaning and durability, vinyl may be preferred by prospective homeowners and tenants over hardwood. Details matter. Consider how you can use the property's current characteristics to increase value rather than replace everything on it. While you are likely to repaint the entire house for a more contemporary appearance, think about these high-impact improvements. Swap out all of the light switches and electrical sockets for ones with the same finish and color. Update all of the hardware. Consider the all-black trend to cut down on material costs and prevent mismatched finishes. Add features like a home security system or digital doorknob, and more. Upgrade the curb appeal. An updated property's curb appeal goes a long way to attract visitors to the home, whether you're preparing to sell or rent it. Buyers will spend 7% more on a home with upgraded curb appeal than a neglected facade. Update your house numbers and mailbox. Touch up the exterior paint or think about adding stone veneer to the front. Paint the current front door a new color and replace the hardware. Spruce up the patio or add an outdoor fire pit, and tidy the landscaping and front porch. You can make these few high-impact exterior updates to your investment property. How to start flipping properties. Comparing buying a turnkey rental property to flipping a house involves certain differences. To buy cheaply, you must have a solid understanding of market patterns. You also need to foresee the price of selling the property while still earning a profit. To flip a house, you must take the following 5 steps. 1. Market analysis. It's far easier to say than to do to buy low and sell high. When flipping a home, you need to pick a property with enough upside potential after deducting the cost of renovations to turn a profit. Generally, middle-class and working-class properties in 2, 3, and 4-star neighborhoods are the greatest places to find a house to flip. 2. Cost estimates for updates and repairs. Successful home flippers concentrate on properties requiring minor cosmetic improvements, such as new flooring or paint, updated plumbing fixtures like sinks and faucets, and stainless steel appliances, compared to solving structural issues like a damaged wall or foundation, which call for using a qualified general contractor and obtaining licenses from the city. Estimating repair costs like these is considerably easier. The 70% rule is used by real estate investors who flip properties for a living to determine the highest bid price for a residence. To determine whether a bargain makes sense, you must know the cost of repairs and the after-repair value, ARV. The maximum offer price for a home that is being flipped can therefore be calculated using the following formula. Maximum offer price equals repair cost minus 70% of ARV. If the ARV of a house you're thinking of flipping is $150,000 and the required repairs cost $15,000, the highest offer price you could make is $90,000. Maximum offer price, $90,000, $150,000 ARV times 70% equals $105,000 minus $15,000 repair cost. 3. Finance arrangements. Using all your money or obtaining a short-term hard money loan are viable methods for financing a house flip. Conventional buy and hold real estate investors typically use leverage to boost total returns. House flippers, on the other hand, strive to enter and exit a deal fast and avoid accruing debt or paying interest because doing so could reduce their prospective upside gains. Additionally, because of the perceived higher risk, most conventional lenders won't offer a loan on a home that is being flipped. Get to know contractors. When you let contractors, handypersons, and material suppliers know you'll be bringing in a steady stream of business, they'll typically offer you better rates. You can lower the possibility that the cost of repairs will be more than anticipated by developing a network of reliable and affordable contractors. The purchase price plus the cost of repairs exceeding the home's fair market value is one bad thing that can happen when flipping a house. If that occurs, you'll have to flip the house at a loss, which no real estate investor likes to do. 5. Purchase a house to flip. The next step is to place the home under contract once you have properly examined the neighborhood real estate market and have discovered a property that would make a profitable flip. Because you're offering below market value, sellers will anticipate a purchase agreement with few conditions and a quick escrow close. The day escrow closes, have your team of contractors prepare to start making repairs. The sooner you complete the updates, the sooner you can sell the home and earn money. How to maximize sales profits. An owner-occupant who will gladly pay more for a great property, entirely remodeled and updated, is one strategy to sell a house you are flipping. To do that, you'll probably need to put the house on the local MLS and pay a 5% to 6% real estate agent commission, which will reduce the profits from the house you are flipping. Renting the property out to a renter is a smart move to make the most of your prospective income when you flip a house. You must perform a thorough tenant screening and season the renter by ensuring the rent is paid on time every month for several months. The house can then be listed on the Roofstock marketplace and marketed to eligible real estate investors as a turnkey rental property. Sales commissions are roughly half of what you would pay through the MLS, and investors in rental property could be willing to pay more for a house that has undergone extensive renovations and is occupied by quality renters. Although this method of selling will extend the period between purchasing and flipping the home, the rental money from the renter will help cover the costs of keeping the home for a few more months. Do the figures using both scenarios to determine whether the money you will realize selling on Roofstock is more than selling on the MLS. Chapter 7. Taxation and Real Estate Investing. You might desire to invest in real estate for a variety of reasons. When a home's value rises over time, it can provide money through appreciation, and if you rent it out, it can generate passive income. Additionally, it's a useful approach to diversify your investment portfolio. Tax advantages of real estate investing include deducting some expenses for rental properties. Real estate taxes, however, may be quite complicated, just like everything else related to the IRS. The tax implications of real estate investing are examined below, along with the main tax advantages to remember. What types of taxes is real estate subject to? Whether you are a property owner or just an investor, the types of taxes you will be exposed to when dealing in real estate may vary. As an illustration, if you own a house or apartment and rent it out, you'll have to pay property taxes to your local or state government and income and capital gains taxes if you ever decide to sell the property for a profit. This is significantly dissimilar from purchasing real estate through a real estate investment trust, REIT, limited partnership, RELP, or crowdfunding. You pay individual income taxes, which don't require you to deal with the burden of owning a home. Here is a summary of the many taxes you may incur if you own or invest in real estate. Property taxes. State and municipal governments levied property or real estate taxes annually to help pay for roads, schools, police and fire departments, and other state and local services. The assessed property valuation, which includes the land, buildings, and other improvements, is typically the basis for calculating property taxes. Property tax rates may vary depending on your city and state. Net investment income tax, NIIT. Interest and dividends are examples of investment revenue from some real estate investing strategies. If you earn a lot of money from investments and are a high earner, you will have to pay NIIT, which the IRS levies at a rate of 3.8% to certain net investment income. According to information provided by the IRS on its website, who must pay this kind of tax depends on filing status and modified adjusted gross income, MAGI. Real estate income tax. Real estate rental income is determined passive income and is subject to ordinary income tax. Take the material participation test to discover whether you actively participated in a business or whether it is passive income to ensure that you fit the IRS's definition of what is deemed passive income. Business income tax. Real estate rental can occasionally be considered a trade or business. This only occurs if you offer services beyond the bare minimum. For instance, you could purchase a home and convert it into a bed and breakfast where you would serve meals and provide linens for visitors. Capital gains. You could make capital gains if you sell a piece of property for more than you paid. Your cost basis is the buy price you paid for the asset plus any renovations and acquisition costs, less depreciation. Your tax rate will determine whether it counts as a short-term or long-term capital gain. Selling properties owned for less than a year result in short-term capital gains subject to regular income tax rates. Depending on your total taxable income, long-term capital gains are taxed at a reduced rate than regular income, with rates between 0% to 20%, and are for assets owned for a year or more. Individual income taxes. Any gains in interest income are taxed at the same rate as your regular income if you are an investor and do not own any property. Tax benefits of investing in real estate. Numerous tax benefits might result from real estate investing. The following aspects of real estate investing can minimize your tax liability and increase your refund when you file, whether you invest in residential or commercial property. Real estate deductions. Deductions for real estate are a great way to reduce your taxable income. Typically, these deductions offset the costs of running a business and managing real estate. Particularly, the following deductions can help you in lowering your taxes: property taxes, mortgage interest, insurance, costs associated with maintaining a property, such as utilities and lawn care, repairs to buildings, deductions for home offices, advertising, travel costs, and costs associated with legal and accounting matters, as well as business supplies like laptops and printers. Because so many tax deductions are available, keeping track of your pertinent expenses is essential. Without thorough records and receipts, it is nearly hard to claim deductions. Additionally, you will need to provide documentation supporting your deductions in the event of an IRS examination. Depreciation. Investors are given a discount for how quickly structures deteriorate over time when they deduct property depreciation from their taxable income. You will specifically receive depreciation during the building per the IRS's schedule. Residential properties currently have a 27.5-year lifespan, whereas commercial properties have a 39-year duration. You are entitled to a depreciation deduction each year based on your own real estate. Say, for instance, that you possess a $50,000 business facility. Its location on the land is irrelevant. If you divide $500,000 by 39 years, your property will be eligible for a $12,820 annual depreciation deduction when you submit your taxes. Capital gains. Selling real estate for a profit triggers capital gains taxes. These taxes can be divided into two groups: short-term taxes and long-term taxes. As said earlier, long-term capital gains are profits from selling assets kept for a year or more, as opposed to short-term capital gains, which are profits from assets held for less than a year. Because the IRS views short-term capital gains as regular income, they are not eligible for tax breaks. Therefore, short-term capital gains may cause you to move up the tax scale more than once, increasing your income taxes. Thankfully, long-term capital gains result in tax benefits. They don't count as regular income and are taxed at a reduced rate than short-term gains. If you realize long-term capital gains, your profit will fall into one of three tax bands: 0%, 15%, or 20%. If you're married and filing together and have an annual income of $89,250 or less, You won't have to pay any long-term capital gains taxes. 1031 exchange. You have to pay capital gains taxes on the sale of an investment property for which you have deducted depreciation and income taxes on all earlier depreciation deductions. By employing a 1031 exchange, you can avoid this tax, referred to as depreciation recapture. If you buy another investment property with a value equal to or greater than the one you sold, you can use this benefit to postpone paying taxes on real estate sales. You can utilize the 1031 exchange rules as often as you like, but don't forget that you will face taxes if you withdraw the proceeds from a sale or use the money to purchase a less expensive property. Passive income and pass-through deductions. You may be eligible for a pass-through deduction if you operate your real estate firm as a sole proprietorship, real estate partnership, LLC, or S-Corp. Using these pass-through businesses, you can deduct 20% of your eligible company income from your taxes. Consider the scenario in which you manage rental properties via a limited real estate partnership. You make $25,000 a year from the business, so you can deduct $5,000 from your income when you file your taxes. Remember that the pass-through deduction, a Tax Cuts and Jobs Act provision, is valid through 2025. After that year, you won't be allowed to claim this deduction if the government doesn't implement any new legislation in this area. Self-employment FICA tax is included. FICA taxes for self-employed individuals typically amount to 15.3% of their income. Rental income, however, is free from this regulation. As a result, you are immune from FICA taxes if you rent out houses. Opportunity zones. Opportunity zones were also introduced under the Tax Cuts and Jobs Act for investors. By purchasing homes in areas where the economy is struggling, you can postpone paying capital gains taxes if you sell real estate. These governmental opportunity zones often require development and higher-paying jobs. The 3 tax advantages of investing in an opportunity zone are as follows. First, you won't have to worry about capital gains taxes until you sell your investment in 2026. Additionally, if you hold on to your investment for 5 or 7 years, you'll receive a 10% basis step-up on your capital gains and a 15% bonus. Finally, if you invest for at least 10 years, you can fully avoid paying capital gains taxes. Tax-deferred retirement accounts. A health savings account, HSA, or individual retirement account, IRA, that permits real estate investment is another method to get started in real estate investing. Taxes on investments can be delayed with these accounts until you take money out of them. Strategies for reducing taxes on real estate investments. Real estate investing has long been a successful strategy for accumulating wealth. What is the secret to real estate investment wealth creation? Tax reductions. Real estate investment income attracts less severe tax penalties than regular income does. Real estate investors that are savvy know what to do to reduce their tax liability and increase their profits. Discover 9 tactics to reduce taxes and help real estate investors like you run a more profitable business. 1. Maintain a property for more than a year. Holding properties for longer than a year is the first move a real estate investor may take to reduce their tax burden. The profit is taxed at your standard income tax rate if you own an investment, such as real estate property, for less than a year and sell it for a profit. If you own a security for more than a year before selling it, you can probably do so at a capital gains tax rate of 15%, which is likely to be less than half of your regular rate. Additionally, if you keep a property for longer than a year, you can profit more by leasing it and then selling it once its value has increased. 2. Have real estate in a self-directed IRA. You are probably already familiar with tax-advantaged retirement savings if you have ever held a W-2 job. Everyone has a different strategy regarding 401k plans, individual retirement accounts, IRAs, and Roth IRAs. You should be aware of the self-directed IRA if you're an investor looking for a tax break. Self-directed IRAs can be invested in various assets, such as real estate, and are held by a custodian. To purchase and own investment properties, you'll probably need to form an LLC or legal corporation, work with a custodian or trust business, and manage your self-directed IRA. This way, you can make tax-free investments in your LLC and properties. 3. Benefit from a 1031 exchange. What if you could sell a house for a profit while avoiding paying taxes on the proceeds? With a Section 1031 exchange, it is feasible. The 1031 exchange, a like-kind exchange, enables you to transfer gains from one real estate investment to another. In contrast, you'll have to pay income or capital gains taxes if you decide to count your profits as income. The best part is that 1031 exchanges allow you to reinvest every time you sell one property and buy another, helping you to accumulate wealth while lowering or avoiding taxes on your assets. 4. Increase your tax deductions. Tax reduction in real estate investing refers to increasing your deductions. Almost all real estate expenses are tax deductible. Fortunately, not just big real estate investors can take advantage of deductions. You always have the option to choose the standard deduction if your itemized deductions aren't very significant. 5. Take advantage of the 20% pass-through deduction. Real estate investors now have access to the 20% pass-through deduction, another tax minimization method that has recently become available. You might be able to deduct a whole 20% of your real estate business income from your taxable income thanks to the pass-through deductions in the Tax Cuts and Jobs Act of 2017, TCJA, which permit some small business owners to deduct an additional 20% of their net business income. The TCJA also includes opportunity zones, places identified as lacking businesses, and may allow you to invest in real estate with a lower tax burden. 6. Borrow rather than sell to realize appreciation. Let's say you purchase a property and keep it for 5 years. If you maintain and care for your asset properly, you should have equity in something worth more than it was 5 years ago. Although selling to cash in on the appreciation might be tempting, astute real estate investors borrow against appreciating assets to reduce their tax liability. You can borrow money against the asset and write off the interest payments on your taxes. Your wealth and access to money will increase as your renters can pay off your loan and your property appreciates. 7. Conduct a payment plan sale. It's unnecessary to cash out and pay taxes immediately after selling a home. Instead, think about selling in installments to lessen your tax obligation. A customer purchases your property through an installment sale and makes payments over several tax years. Doing this lets you categorize your profits as long-term capital gains instead of short-term ones. Installment sales ultimately save you money since long-term capital gains are taxed at a minimized rate. 8. Avoid paying double FICA taxes. Social Security and Medicare are funded by FICA taxes, which are employment taxes. Employers and employees each pay 7.65% in taxes, and self-employed people are responsible for paying 15.3% of their real estate investment income in taxes. This could be prevented. You don't want to be labeled by the IRS as a dealer or someone who primarily owns a property to sell it if you're a real estate investor. Instead, show investing intent to avoid dealer status and double FICA taxes. Demonstrate that you are selling properties to raise money for other types of investments, including a down payment or improvement fees. You can also think about creating a legal entity with the help of an accountant, such as a partnership, LLC, or S Corp, which has different tax expectations. 9. Depreciate properties. Real estate investors may seek appreciation, but doing so entails costs because greater property values result in higher property taxes. By depreciating your property, you can mitigate the tax implications of appreciation. A portion of the building value of your property may be written down each year. You can also depreciate capital improvements, saving you money until you sell the property and have to pay for depreciation recapture. Conclusion. Real estate can be a wise investment with the ability to generate consistent income and increase wealth. Illiquidity, or the relative difficulty in changing cash into an asset and an asset into cash, is still a disadvantage of investing in real estate. Unlike a stock or bond transaction, a real estate deal may take months to finalize, which can be finished in seconds. Finding the ideal counterparty can take weeks, even with a broker's assistance. Of course, real estate mutual funds and REITs offer higher liquidity and market pricing. But because they have a considerably stronger link to the general stock market than direct real estate investments, they come at the cost of greater volatility and fewer diversification advantages. Keep your expectations reasonable, just like with any investment, and do your study and homework before making any choices. Real estate has repeatedly been shown to be a very profitable investment instrument, but one of the biggest difficulties in entry is understanding how to invest in real estate. The good news is that everyone can learn how to invest in real estate. All it takes is time spent on self-education. This is the reason we created this special beginner's guide. Whatever your starting point, there is no justification for making real estate off limits. A successful real estate professional can be accessed through several investing strategies. Find the best strategy for yourself by taking the time to study real estate investment for beginners.
We appreciate you tuning in to one of our captivating audiobooks. For more immersive experiences, here is another audiobook we're certain you'll enjoy. Don't forget to show your support by liking this video, sharing what you loved about this audiobook in the comments section below, and subscribing for more captivating audiobooks like this. Thanks for being a part of our audiobook community.